SEC's mandatory statutory authority. While the Securities and Exchange Commission is engaged in a wide-ranging regulatory agenda, you seem to have overlooked the importance of public input, resulting in bipartisan bicameral concerns. Members of both sides of the aisle have raised valid concerns regarding the MiFID relief, swing pricing, hard close, as well as your equity market structure overhaul. The Securities and Exchange Commission has taken no action to address these concerns. Second, you continue to fail to prioritize capital formation. Among your expansive rulemaking agenda items, there is not a single initiative aimed at improving access to capital or enhancing market competitiveness. Third, your efforts to choke off the digital asset ecosystem, which has created real harm for consumers and our markets, is clear to all. You said the law is clear, but your actions have created more confusion and lasting damage. Chair Gensler, you've also said your goal is consumer protection. Yet your actions have pushed legitimate digital asset activities outside of regulated financial institutions where consumers are best protected. On one hand, we've seen bipartisan votes in Congress, in this committee, to provide clear rules of the road and real consumer protection. And on the other, we've seen your ad hoc regulation by enforcement approach to digital assets on a losing streak in the courts. You refuse to be transparent with Congress regarding your interactions with FTX and Sam Bankman-Fried. That's the investigation we started last Congress. Finally, your lack of responsiveness to this committee's legitimate oversight continues to be unacceptable. And I want to finish here. In February, the committee made multiple requests for documents to the Securities and Exchange Commission. This is normal congressional oversight. Yet 7 months later, the committee has not received a single non-public document that was not part of a FOIA production. As I said, our patience is wearing thin. The SEC is not above the law, nor is it unique. Other financial regulators have routinely complied with congressional oversight. So let me be clear. I do not want to be the first chairman of this committee to issue a subpoena to the Securities and Exchange Commission. And you should not want to be the first SEC chair to receive a congressional subpoena. Either we find a path forward where the SEC recognizes Congress as a co-equal branch of government and is responsive to our oversight duties, or my option is to issue a subpoena. It's time for you to consider the lasting consequences of your actions, and what that means to the Securities and Exchange Commission's reputation long term. While your time in this role may be temporary, the repercussions for your actions may be permanent for the agency. I yield back. Now recognize the ranking member of the committee for 4 minutes for an opening statement.
Good morning. The chairman just indicated that his patience is running thin. Mine is thinner with the opposite side of the aisle and the extreme MAGA Republicans who have taken over the House of Representatives and who are gleefully forcing the government of the greatest country in the world to shut down and forcing millions of government workers, including U.S. service members protecting the economy, to work for free or not at all. Likewise, in 3 days, the Securities and Exchange Commission, which is in charge of overseeing our $110 trillion capital markets, will also be shuttered. This extreme MAGA shutdown would cripple the SEC's ability to stop fraud, help businesses raise money, or finalize rules that are critical to investors. But you won't hear the Republicans today express any concern about the SEC or the countless businesses, workers, or investors that may be harmed when Republicans unilaterally defund Wall Street's cop. Chair Gensler, I know that you and your agency are likely concerned about what will happen later this week. I, too, am concerned. Earlier this year, we saw Fitch downgrade the U.S. credit rating after Republicans tried to force a default, and now Moody's is also considering downgrading the U.S. rating if Republicans and Trump get the shutdown they so desperately want. I hope we can discuss today how undermining the SEC's mission by furloughing 90% of your staff will affect this country and your ability to protect our markets. That said, I want you to know that you're doing exactly the job that the American people want. Under your leadership, the SEC is providing investors with the information they need to evaluate climate change risk. You are reforming the stock market, which failed investors during the GameStop trading event. And you're working to empower investors to exercise their votes over companies they own. I'm also pleased to see that you're finalizing rules that will bring transparency to private funds, like private equity funds. And although Republicans will likely claim that the SEC is implementing too many rules too quickly, the fact is that you're moving thoughtfully and effectively. In fact, your SEC has issued fewer rules than the Trump, Obama, and Bush administrations at this point in their tenure, and you've provided twice as much time to comment than is required by law. The SEC is very much implementing the priorities that I and my Democratic colleagues championed when we were in charge, and is shaping up to be the most pro-worker, pro-investor, pro-small business SEC since FDR created the agency. Chair Gensler, I appreciate that you're here today, even as you and your staff prepare to close the agency. I hope that if nothing else comes of this hearing, the American people will understand that this extreme MAGA Republican shutdown is the biggest threat to our nation's investors, small businesses, and working families. My patient is wearing thinner than the chairman's patient. Let's get on with it. I yield back.
The ranking member yields back. The chair recognizes Ms. Wagner, the chairman of the Subcommittee on Capital Markets, for 1 minute.
Thank you, Chairman McHenry. Yes, let's get on with it. The SEC's mission is to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. Unfortunately, your leadership has undermined these core objectives, sir. None of the 50-odd proposals your SEC has proposed promotes capital formation. Instead, the focus has shifted towards imposing costly regulatory and disclosure requirements. Equally troubling and potential violations of the Administrative Procedure Act, as recent SEC proposals lack a comprehensive analysis of market dynamics and their consequences, especially for SEC rules that have been changed. Here's the way forward, sir. 1, begin with a robust engagement with market participants to shape your thinking before proposing rules. 2, conduct investor testing. 3, economic analysis, and looking at not just the individuals, but the cumulative. 4, do not ignore Congress when you send bipartisan letters expressing concerns about detrimental effects of the proposals. We need market integrity. I yield back.
We'll now recognize the ranking member of the Capital Markets Subcommittee, Mr. Sherman of California, for 1 minute.
Mr. Gensler, you've done more than anyone in government to thwart the creation of an efficient ecosystem that will allow corrupt politicians to not have to have hundreds of thousands of dollars of cash and gold bars in their home when they could be discovered by the FBI. You prevented a system where we can have anonymous, unhosted wallets providing an efficient method for the corrupt politicians of the future. You are providing additional regulations which provide clarity to the market participants and protect investors. But according to a Bloomberg study, you're actually producing fewer regulations than your predecessor, recent predecessors. You're generally right, except swing pricing. And finally, ESG is material to investors. It will affect trillions of dollars of investment decisions. That's why corporate America is trying to prevent you from getting that information to the investors who want it.
Gentleman's time's expired. We'll now recognize the chair of the Securities and Exchange Commission.
Good morning.
For 5 minutes for an oral presentation of his testimony. Without objection, your written statement will be made a part of the record. Chair Gensler, you're now recognized for 5 minutes.
Good morning, Chair McHenry, Ranking Member Waters, and members of the committee. Thank you for inviting me here today. As is customary, I'd like to note that my views are my own as chair of the SEC, and I am not speaking on behalf of my fellow commissioners or the SEC staff. For 90 years, the federal securities laws and our work to oversee them have played a crucial role for the public, both in good times and in stress times. The core principles of the U.S. securities markets regulation have contributed to America's economic success and geopolitical standing. At this remarkable agency, we serve investors building for a better future and issuers raising money to fund innovation while overseeing the $100 trillion capital markets where investors and issuers meet. The essence of this captured in our three-part mission: protecting investors, maintaining fair, orderly, efficient markets in the middle, and facilitating capital formation, as Chair Wagner mentioned earlier and Chair McHenry. The SEC is the cop on the beat watching out for constituents. The dedicated staff of the agency does an extraordinary job with limited resources. America is blessed with the largest, most sophisticated, and most innovative capital markets in the world, but we cannot take this for granted. Even a gold medalist must keep training. That's why we're updating our rules for the technology and business models of the 2020s. My written testimony details those efforts, and I'm sure I'll get questions on this rule or that rule, but I'd like to just point out overall a context. We're updating our rules to promote the efficiency, integrity, and resiliency of the middle, the markets in the middle, and that helps capital formation on one side, investors on the other, and we do so with an eye on those investors and issuers and making sure the markets work for them rather than issuers and investors working for Wall Street and the markets in the middle. We're working to help lower cost, increase access, and promote financial stability, and each of the proposals we've made in the last 2 years further this three-part mission, given the authorities granted by Congress. And our Division of Economic and Risk Analysis provides robust economic analysis, which consider the cost and benefits, as well as effects on efficiency, competition, and capital formation as Congress mandated. We greatly benefit also from public input regarding economics, the policies themselves, our legal authorities, and we get that feedback. And in the last 2 years, we've provided the public ample time to comment, with an average 70 days to comment from the time the proposal is published. And since January of last year, 22, we've always had a minimum of 60 days from when it's on our website, sometimes as long as 100 days. When comment periods close, we often continue to get additional comments through meetings and otherwise, which staff has considered as well, including really helpful letters from members of this committee. Based on the public feedback, the staff and the Commission consider possible adjustments to the proposals and whether it's appropriate to move forward with the final rule. This process normally takes 12 to 24 months, and we move to adopt rules only when the staff and the Commission think they are ready to be considered. We're focused on getting it right based upon the economics, the authorities, promoting the mission, not against a clock. The SEC now has issued proposals for most of that unified agenda from 2 years ago. We finalized 24 rulemakings, nearly all of which have changed from the proposals based on the public feedback, including from members of this committee. I'm grateful to work alongside a remarkable staff and fellow commissioners to promote efficiency, integrity, and resiliency. With the possibility of a government shutdown, I would note, as our oversight committee, that we would be down to a small skeletal staff, about 7-8% of our staff, everybody else being furloughed. Normal oversight of the markets, given this, will not be possible in the SEC during the pendency of a shutdown, so we look forward to the day when we can get back to work, hopefully, and fulfill our mission in support of the public. Thank you.
Gentleman yields back. Will now recognize myself for 5 minutes. Chair Gensler, last time we were here, I asked you about Ether. In 2018, you stated that Bitcoin, Ether, Litecoin, and Bitcoin Cash are not securities. So I want to focus today on Bitcoin. Why do you believe Bitcoin is not a security?
Thank you, Chair, and I think you're referencing remarks I made as a professor at MIT. And as I wrote in that paper at that time, It was really about something called the Howey test. And the Supreme Court, it's the law of the land, talks about if the public is anticipating a profit based on the efforts of others. And as I think I noted in that paper back in 2018, I didn't see that Bitcoin met
But your
that.
view on Bitcoin, you've made comments on this. You believe Bitcoin is not a security. Is that true?
Well, I think the staff of the SEC have also, and the prior
Well,
chair.
I'm just asking you this question, and this is not a gotcha. I thought there was going to be an easy softball into harder questions. Do you think Bitcoin is a security?
No, I think I've said this in the past that I think that it doesn't
I'm asking you
meet the
to
Howey
answer
test.
my question now. This is not supposed to be hard.
I know. I said it
Just
does
to answer-
not meet the Howey test, which is the
Okay.
law of the land about being an
So
investment
it doesn't meet the
contract
Howey
and
test.
security.
So therefore, it's a commodity. Is that fair?
I would say it's not a security, and then the test is otherwise for other
Okay.
laws.
Well, the CFTC says they don't have the authority over Bitcoin and digital commodities. Do you think legislation is necessary to protect consumers in the world of digital assets, in particular, given that gap around just Bitcoin?
I think, as I've testified here in this committee room 4 years ago as a private citizen, that for the parts of the crypto ecosystem that are not securities, though under the Commodities Exchange Act the CFTC has some anti-fraud authorities, they don't have what's called plenary authority to write rules around that. And as I've said in the past, I've been supportive of our sister agency, if I can say that, an agency that I once was honored to chair and I like quite a bit, doesn't have that plenary authority, and if Congress moved forward on that, that could help them.
So the spot market lacks a regulatory paradigm and established law. So should we take action there?
I'm sorry, I'm not sure I follow. The U.S. stock market you're talking about, the securities
No,
market?
the CFTC. I'm continuing with your answer. My follow-up there was because there's not a regulatory remit that Congress has given them, clear regulatory remit, we should step in. So let me just move on. I've talked about your noncompliance with document requests made by this committee. You believe the commission must vote in order to produce non-public information to this committee. Do you not?
Under the Exchange Act, I do believe that the commission needs
So,
that vote.
have you scheduled a vote necessary to provide the non-public documents to this committee?
We, I think, have been working with your staff and believe in oversight of this committee, we've provided somewhere over 40,000 pages
Yes,
of
nothing,
documents.
as I said in my opening statement, nothing that was non-public did you provide. In fact, you produced one of the letters that we wrote to you as responsive documents. It showed the absurdity of it. So the General Counsel's office has indicated to my staff that after a 10-week review process, these documents are ready to be transmitted. It just needs a vote. When do you intend to schedule that vote?
We continue to work with you and your staff. We've had, the commission has approved that some senior staff will be taking transcribed interviews, I think, with your staff. And we've
But that is not
approved that.
responsive to my document requests.
We
This
continue-
should not be the hard work of a chairman to answer these questions. You have 30 major rulemakings, but you won't even provide basic documents to us. Your unresponsiveness is noncompliance, and we'll have to take action if you're not willing to comply. You have a 10-week review process, and you've not provided documents. Furthermore, you haven't even done the economic analysis of your interplay of these major rulemakings that are going to affect anybody who owns a stock, bond, or any type of security. And so you've got serious questions to answer to the public and to Congress, and we intend to get your compliance. We can do it the easy way or the hard way. And with that, I yield back. The ranking member is now recognized for 5 minutes.
Thank you very much. There are a number of questions that I would like to ask, but since we started out on Bitcoin, let's go further into crypto. Chair Gensler, I've heard you often say there is mass noncompliance by crypto firms in the marketplace today. I'm very concerned with what sounds like gross violations of the law that end in investors getting ripped off. The failures and fraud of crypto firms like Terra Luna, for example, cost investors as much as $60 billion, which was larger than the Madoff Ponzi scheme in 2008. I know that the SEC has brought enforcement actions against Sam Bankman-Fried and FTX, the failure of which cost investors $9 billion. Since we're talking about, everything today, can you please describe the actions that the SEC has taken to shut down crypto firms and recover funds for harmed investors? How much in penalties have defendants paid in cases you have settled? Are crypto firms getting the message?
Thank you. I do share your concerns that this is a field that's rife with fraud and manipulation and scams, and the American public is still getting hurt by the non-compliance in this field. In terms of the SEC's approach, it's both through policy and rulemaking and, yes, in enforcement. The SEC had finalized rules with regard to special purpose broker-dealers in crypto, and we also addressed questions that came up about crypto exchanges, the custody of crypto in a custody rule that I imagine we'll chat a little bit about later today, and even best execution. But unfortunately, as you noted, we've brought numerous cases in this field to try to protect the American public and be a cop on the beat with regard to so many of these schemes.
Thank you very much. I just wanted to make sure that the opposite side of the aisle, who protects too often in too many different ways crypto firms, that they know what you're doing. Let me move on. I'm going to ask a few questions about the impact of the government shutdown on SEC's operation. Chair Gensler, approximately how many people work at the agency, and what percentage will be furloughed during a government shutdown?
We have just under 5,000 employees, and probably 92 or 3% will be furloughed. So we'll be down to a skeletal staff.
Which divisions would most be impacted, and describe for us what these divisions do?
It's really across the whole agency, but the bulk of our workforce is in examinations, in enforcement, in disclosure review. But let me say what the public won't have. They won't have somebody really at full force overseeing the market. For companies that want to go public, we won't be able to really review the documents, or what's called documents going effective if you want to do an initial public offering, which is so critical to capital formation. We will keep open, I want to say this for the public, we will keep open our tips, complaint, and referral lines. We will keep open comment files so people can still submit comments on our rulemaking and the like, but we won't really have individuals behind the scenes to follow up except
I,
for
too, am worried
staff.
about public offerings. I've worked with the opposite side of the aisle to improve the ability of those who want to do IPOs, but as you explain it, this will have a negative impact, the shutdown, on the ability for IPOs to be initiated. Is that correct?
I think that's just a practical reality, yes.
What happens if a whistleblower comes to the commission with urgent information that could protect investors? Would there be staff to process this? Could the commission deploy resources in response to this information?
Though we will be able to intake, there won't be the usual investigative force of individuals to follow up as readily unless it's an emergency and it's about specifically protection of property.
What will happen if there's a major disruption in the capital markets operations and infrastructure during the shutdown? Could the SEC be there to respond?
It's a very good question. I mean, if there were a market event, as you say, senior leadership would be there, but again, we'd be down to a skeletal staff.
And so
Gentlelady's time's expired. We'll now go to the Vice Chair of the full committee, Mr. Hill of Arkansas, for 5 minutes.
Thank you, Mr. Chairman. Mr. Gensler, it's good to have you. I want to start out today and talk about equity market structure as a topic. Just yesterday, Congressman Foster and I sent you a letter signed by 16 Democrats and 16 Republicans to express our concerns about the equity market structure proposals that the Commission has initiated. The letter urges you quite simply to stop your rulemaking on that broad set of proposals until you finalize the trade execution data rule, the so-called 605 data rule, and that be done first so that you can rely on that data for an appropriate rulemaking. And this speaks to Mr. McHenry's point about the interplay between the rules, which, contrary to the ranking member, I think there are 50 pending proposals. Many of them interact. They are confusing and sometimes in conflict with each other, and I think this is a classic example. And I think it's particularly true where you're failing to do a rigorous cost-benefit analysis for many of the rules. For instance, the SEC's dealer proposal, which uses the word uncertain 15 times to describe its impact on efficiency and competition for the most important financial market in the world, U.S. Treasuries. So, Mr. Chairman, I would just say this is not MAGA Republicans that are sending you a critical letter of concern. It's a very bipartisan view, 32 members of this body that think the SEC should reconsider. Would you wait for the Rule 605 data before you finish the other equity market proposals?
I thank you for the letter. I did read it last night around 9:30 when it came in, and it's part of our comment file. We'll take it and think of it very seriously. But I would say in terms of the equity markets, the rules have largely not been updated since 2005.
That may be, but that means that we need to do it in a comprehensive way, in an interoperative way, and make sure we have the right data. So I'll take your short answer as no that it's a comment, but I really urge you to get these equity markets proposals in order and to rely on data and not just emotion or one meme stock event to make policy. Let me change subjects. Let me talk about my favorite kitty cat, which is the CAT, Consolidated Audit Trail. For over a decade, this bad idea has been floating around the Commission since the flash crash in 2010 to collect and store private personal information on every American and every American with a brokerage account at every broker-dealer. In my view, this is a massive overkill. This is unnecessary invasion of privacy. This is a massive new tax on the brokerage account of individual American citizens. And maybe worst of all, considering the 9 years I've been here, this is another massive centralized government database that's going to be hacked, like the IRS, like the CFPB, like OPM. And so I've got real concerns about it, and I continue to express those for Mary Jo White, for Mr. Clayton, and now for you. In fact, you inherited this albatross. Why don't you just bury it and say that we're not going to do the CAT?
Though I inherited not only from them, but I inherited from my dad a real allergy to cats, and it's real.
Oh, my God.
Oh, my God.
Yeah. Well, we don't have time for that. I'm reclaiming my time. We can have a cat visit. We can do the kitty part later. Do you know what a targeted exam letter is by the FINRA? Do you know what that is?
I'm familiar with exam letters.
Yep. And do you know what a blue sheet is?
Sir, I'm generally familiar. I don't know where you're headed, but I'm generally familiar.
And you know that all of our markets have regular daily, intraday, overnight global market surveillance on trading, right? That's a general feature of all of our SROs, right? You agree with that?
SROs are responsible to do that, sir.
Yeah, I understand that. And you regulate the SROs. So what I'm suggesting to you is there's no justification for capturing all these trades when you have right now market surveillance data available to Enforcement Division. And you can right now do a sweep exam through a blue sheet, which is where you go to large traders and you look at everybody who traded in Apple. You can get all the PII you want because you have a probable cause for doing that. And that's why CAT, I think, exceeds what you should be doing. Why is the blue sheet targeted exam process inadequate for you to do your job?
So I think you raise a good question, but the Consolidated Audit Trail gives the self-regulatory organizations and the SEC a look at those orders and matches up sometimes.
They've got the ability to do that now. They don't need to capture everybody's trade in every retail brokerage account in America. Mr. Chairman, I yield back.
Gentleman yields back. We'll now recognize the ranking member of the Capital Markets Subcommittee, Mr. Sherman of California.
As the chairman points out, it's about capital formation. You're at the nerve center of the world capitalist system, where capital is deployed to operating businesses. If we have a shutdown of the government, I think it's already been pointed out by the ranking member that we stop all IPOs in their tracks. Does this also apply to companies that are already public but are issuing additional shares? And does it also apply to new bond issuances?
I'm glad to follow up and have staff chat with you. It's more nuanced. It really depends on whether they have filings that they can.
So a few of them are sophisticated.
Many public companies would be foreclosed from doing additional offerings. Others would be allowed. It really depends on the nature of their filings.
So a huge portion of our $100 trillion capital markets are not available to raise additional capital, or a huge portion of the initial capital that would be raised for operating businesses would be blocked. We also, as I understand, as far as providing assurance for the honesty of markets, you'll continue to collect emails as they come in, but you won't be doing any investigations or opening any additional investigatory files, correct?
It's really prescribed and narrow. It relates to a 19th century law called the Inefficiency Act, but we can protect public property. But it's
okay.
Really
so nobody's going to be stealing your computers, but you're not going to be. It's going to be the Wild West on Wall Street, all while we're fighting for capital with other countries and other capital market systems. And we put up a sign that says, closed. I can't think of a worse thing we could do to American capitalism. Swing pricing, I think it doesn't achieve its purpose. We should want people to invest in mutual funds and diversify and invest in America. But the swing pricing rule you've put forward has been criticized by a letter signed by the vast majority of Democrats on the Capital Markets Subcommittee, many Republicans, I think the vast majority there, the Consumer Federation of America. It seems to be an unfair rule in that giant players can participate in CITs rather than mutual funds, get the same benefits, not be subject to this rule. Investors will be told you may not get your net asset value. People who live in the Pacific time zone are disadvantaged. Any chance you'll be taking this rule back to the drawing board?
We've got a lot of comments. I'm very familiar with the letter that you and Representative Wagner co-authored. It's really going at a core feature that when you have a mutual fund, if you redeem in that mutual fund, you should redeem at the right price so that the remaining shareholders don't get dilution. It works well in normal times, less well in stress times, but we're taking all of these into consideration.
I understand. I'll simply point out that for many years, thousands of mutual funds, all competing for capital, could have adopted this rule, and not a single one of them thought, oh, this is what investors want. This is what will seem fair to investors. You've got the safeguarding rule. I'll simply comment that I think we need a safeguarding rule for intangible assets. Has that? I would hope that you would, if you feel that tangible assets such as real estate need a safeguarding rule, that you would write a separate rule. Is the safeguarding rule that you're writing pretty much structured around intangible assets such as crypto?
No, its genesis, it came from Congress itself. And as part of Dodd-Frank 13 years ago, there was a new provision that the SEC addressed the custody of all customer assets by investment advisors. So it expanded it from just funds and securities to all assets. That was the genesis.
I would hope that the rule would have separate sections and a completely different approach for real estate on the one hand and crypto on the other. Real estate the title is public and the asset isn't moving anywhere, and intangible assets and crypto are very different. I believe my time has expired.
It does have separate sections, but we'll take that under advisement, and it's so good to see Representative.
Gentleman's time's expired. We'll now recognize the gentleman from Oklahoma making his valiant return after tussling with a bull.
Yes, sir.
Happy to have you back, Frank.
Thank you, Mr. Chairman, and I very much appreciate that. And I would note to my colleagues, it has been a long time since I've sat this far down in a committee hearing. But after my interaction with the 1,000-pound bull, I'm just happy to be here. So with that, thank you. And I have the
ask
opportunity.
unanimous consent to restore the gentleman's time. We're happy to have you back, Frank.
Thank you. And my opportunity to visit with my old friend from many encounters and many discussions. Before I begin my questions, I'd like to reiterate a few points made in the bipartisan letter that I sent regarding the SEC's 2 proposed rulemakings on security-based swaps and security loans. And I'd like to enter that letter into the record, Mr. Chairman.
Without objection.
These proposals, I believe, could impair market liquidity while increasing risks and cost. And to avoid unintended negative consequences, the SEC should study the data for regulatory purposes before moving forward with public dissemination. This is consistent with the Dodd-Frank Act, and I hope the Commission will give serious consideration to this approach. Now, Chairman Gensler, I'd like to focus on the proposed rule branded as the Safeguarding Advisory Client Assets. The proposed rule would impose requirements that are inconsistent with the CFTC rules, and you've spent a good bit of time working on CFTC rules in a past life, and would indirectly give the SEC, I fear, authority over the CFTC's regulated markets. And in addition to being outside of the SEC's authority, this would create the significant problems, I think, across the entire financial markets. Have you consulted with the CFTC on the impact of the proposed rule? And if so, for curiosity, what was their feedback?
First, Representative Lucas, it's so good to see you. And your letter with regard to securities-based swaps not only gained my attention, but there are many people at the SEC. I would say this is Representative Lucas's letter. Will you please take a close look at it?
Thank you.
But on your topic and your question about safeguarding of assets, the staff has consulted with fellow regulators at the CFTC about that safeguarding rule, taken their thoughts into consideration. We're some time away. I mean, this was only proposed earlier this year, and it usually takes 12 to 24 months before we even consider adoption. But I think that there are paths forward in terms of the intersection between their Rule 1.25 and these custody rules.
I just think it's imperative that the SEC refrain from applying the proposal to CFTC regulated markets, and I hope that you'll be able to commit to that, even if it means perhaps at some point withdrawing the rule entirely. Now, second question. The Commission has also recently proposed a rule regarding the use of predictive data analytics used by broker-dealers and investment advisors. The proposed rule casts a broad net over what is considered a covered technology. And I quote directly from the rule. A covered technology is defined as an analytical, technological, computational function, an algorithm, a model, a correlation matrix, or similar method of process that optimizes, predicts, guides, forecasts, or directs investment-related behaviors or outcomes. What a mouthful. The included economic analysis explains that the rule would require a substantial resources to comply with and would prevent smaller firms from entering the market or adopting new technology at all. So, Chair Gensler, could you clarify what technologies are covered, and is the intent of the rule to make it difficult for firms to employ certain kinds of technology?
The intent of the rule, A, is to be technology neutral, and it's only about one really core thing, is that when investment advisors or broker-dealers interact with investors, that interaction, that if they're using, as you said, a covered technology, but predictive data analytics, that they continue to put the investor's interest ahead of their own, and they not, in reverse, put the investment advisor's interest ahead of the investing public. That's the core of this proposal.
I'd simply add that given the rapid advances in machine learning and generative AI, the United States should lead the way in the development of innovative technologies that would unlock new economic opportunities, and we should be careful not to be so hostile to new technologies that we stop innovation in its tracks. With that, I'll simply say thank you, Mr. Chairman, and to Mr. Chairman, I spent 7 weeks being calm and at home. I've not been that calm and that long at home since 1986. I'm happy to be back with all of you. And with you, Mr. Chairman. Yield back.
Well, Frank, we're happy to have you back. And as a former chair of current chair of one and a former chair of another committee, we honored the old bulls.
And I missed the ranking member, too.
We'll now recognize another ranking member of full committee, Mr. Meeks in New York, for 5 minutes.
Thank you, Mr. Chairman. And thank you, Chairman Gensler, for appearing before us today. Now, over the course of the last few months, I've had the opportunity to both ask the SEC's Director of the Division of Economic and Risk Analysis and the Director of the Division of Investment Management about the private funds rules. In particular, I've asked about revisiting the economic analysis to ensure that it adequately considered the disparate impact on emerging minority and women-owned asset management firms, minority and women-owned businesses, and historically underinvested communities. Dr. Wachter assured me that the SEC shared my concerns, and Director Birdthistle testified that the economic impact analysis was expanded to look into these concerns. So my question to you is, can you confirm that the economic analysis was expanded? And if so, can you speak to the specific changes that were made in response to the findings from that expanded analysis?
The rule, as other rules do, considers the effect on small businesses. And in this rule, particularly, the economic analysis looked about small businesses, including those that are women-owned and minority-owned, investment advisors running private funds.
So I would like to follow up on that, but I got so many questions I want to ask you because it is really important about to get more details of what those findings were. But I'll ask you more about that in writing and get a response, because I want to shift to a related issue that I find to be disturbing. On page 553 of the private funds rules, the Commission seems to seriously suggest that smaller investment advisors, who we know are likely to be predominantly minority and women-owned, consider reducing their assets under management to avoid registering with the SEC to help mitigate the impact of the rule to them. Now, Mr. Chairman, we know that minority-owned firms are 3 to 4 times more likely to fund minority enterprises and their portfolio companies. So wouldn't telling these firms to stifle their own growth perpetuate the lack of diverse representation in the industry and therefore decrease the amount of funding going to diverse entrepreneurs?
As the economic analysis noted and you just read, there are often some firms, whether it's in a rule like this or other rules, that are right at a cutoff point, where they might be registered and regulated and not, that they might make different choices. But overall, this rule is actually really helpful because it promotes competition and transparency. The biggest fund managers would have to provide greater transparency to their investors, and the smaller asset managers can actually benefit from that greater transparency and competition around the side letters that they might be cutting with large asset pension funds and the like. So it's really a balancing of these economic considerations. It was pro-capital formation, it was pro-investor because it promotes transparency in the middle of the market, that asset managers would have transparency about their fees, their performance, and these so-called side letters that they enter into.
Well, I just have problems with it because it seems to me, again, you're telling these asset managers to not grow, to continue to build where they can do more because of the people that they serve. So it's an issue for me, but of which I'll follow up on. Under your leadership, the SEC has been, incredibly active, and I'll leave it to others to discuss the pace and the breadth of the Commission's rulemaking. But what I wonder is whether or not the SEC considers how their proposed rules will interact with existing and draft rules during the rulemaking process, particularly when it comes to economic impact of the finalized and pending rules. And do you think there would be any value to doing a whole holistic analysis?
We do. In each economic analysis, which often runs between 100 and 250 pages, each of those considers other rules that may have been adopted and adjusts the baseline in each of those analyses.
We'll now recognize the gentleman from Texas, Mr. Sessions, for 5 minutes.
Mr. Chairman, thank you very much, and I appreciate the gentleman, my friend, Mr. Meeks, for his conversation with Chairman. Chairman, welcome once again to the committee.
Good to see you, sir.
Thank you very much. Mr. Chairman, I think that there's a lot of happy talk and smiling that takes place from you and your agency as they come up here and they try and talk about two principles of listening to stakeholders and industry participation, and yet I think you're hearing across this committee a wish that we could have a better relationship with you and your entire organization, and we have prodded them, sent letters, done everything nice that you can do, and yet we show up here and we find a way to provide feedback. We'd like to sincerely turn that around. As you know, you and I spoke a couple of years ago about an issue that still is unresolved because the SEC would not even let this firm know what their problem was. And you told me it will take at least 214 days because that's how long it takes us before we're able to turn issues around when your Fort Worth office already knew the answer. And I think it's this kind of action on behalf of the SEC that causes members of Congress to react the way we do. Mr. Chairman, I'd like to turn to an issue. Last November, the SEC announced a massive increase in enforcement fines, $6.4 billion in 22, up from $3.8 billion in 21. And you have launched a regulatory crusade against the financial service industry through enforcement. You've told us that. We see this. Can you please tell me what the money from these enforcement actions, what you've done with it, and where that money goes?
First, sir, if I may, I think the matter you talked to me about a week or so ago, we filed a civil litigated matter against that company. So I think that's all a matter of public record.
Well, then I've learned that now. Thank you. But for the 2 years prior to that, there was an attempt to be resolution, and you even blocked that company from their counsel, who was very capable from engaging in that, knowing what that was, to where they could have corrected that or found a way to work with it, because it put at least $50 million directly at risk. Mr. Chairman, can you explain where the money from these enforcement penalties is winding up?
There's a number of places. Much of it goes into what's called fair funds. Congress helps set up a process where the public can actually get money back. Those that are harmed can get money back. And some of the penalties and so forth, go into the U.S. Treasury. So that some in fair funds and back to those that have been hurt, but some, of course, also into the U.S. Treasury.
So the SEC takes the money in, follows the laws that have been established, and that is...
Yeah, we're funded separately. We're appropriated, and then we're funded by fees that are fees on transactions in the...
Yes, sir. I just wanted to make sure that it's as a result of what Congress has established with the fair funds about what they would do with that money. And your testimony today is that's what you've done with the $6.4 billion?
Not all of it, sir.
Well, then please tell me what
We can
add a comma and add the rest.
No, we can follow up with the details because of that six.
I am interested in following up the details, and I would ask that your staff accept, just like Congressman Lucas sends a staff and your staff knows, oh, we got a letter from Congressman Lucas, let's respond very quickly here. I'd like to send you a letter today asking for those details.
Thank you. The actual breakdown is a matter of public record. We put it on in our financials each year. I just don't have it memorized.
Well, that's fair. I would not either. Mr. Chairman, we really, I think, would like to, on a bipartisan basis up here, have better interaction with your organization and with you. And I think what you've heard today is another calling on a bipartisan basis for us to do that. We believe if we express our opinion, you should express yours back, not just delay that. I want to thank you for being here, sir, and I will engage you on this matter. Mr. Chairman, I yield back.
Gentleman's time has expired. Gentleman yields back. The gentleman from Georgia, Mr. Scott's recognized for 5 minutes.
Thank you very much. First of all, Chair Gensler, I agree with our ranking member, Ms. Waters. I believe you're doing an excellent job. Excuse my cold. An excellent job at a very difficult and challenging time facing our economy and especially our securities markets. On July 12th, my good Republican friend, Congressman Frank Lucas, and I sent you a follow-up letter with respect to the SEC's proposed rule regarding the impact of publicly disclosing proprietary positions in large security-based swaps above certain reporting thresholds. And specifically, Congressman Lucas and I, we raised concerns with how this move could impair market liquidity and hinder the SEC's core mission to maintain fair and orderly and efficient markets. So my question to you is, first, I know you have previously said you understood the law to require some public availability of this sensitive information. But can you expand on whether widespread public access to large SBS positions could in any way impair the ability of market participants to operate their trading business or limit their ability to hedge effectively?
We continue to consider at the staff level and the commission level, not just your comment letter with Representative Lucas, but others about this. But securities-based swaps can be used to basically replicate the positions that are taken in the stock and bond markets, but particularly in the stock markets. And you might recall about 2 years ago there was a family office called Archegos that did that, and did that in quite some size. So that's one of the reasons, not the only reason, but one of the reasons. Just we look at this and we say, Congress gave us this authority. This is one of the remaining authorities we had not addressed from Dodd-Frank. And so we took it up. We put a proposal out about the possible requirements to report to the commission, and then in some cases report publicly these large either credit default swaps or total return swaps that, of course, credit default swaps were at the center of the 2008 crisis, and total return swaps were at the center of this one example, this Archegos example.
Yeah, now let me ask you this question. Do you see any risk in allowing the public to take advantage of this information, for example, by facilitating front-running and copycat trading, which could drive up the costs for all market participants.
I believe we've gotten that comment from a number of commenters. It's taken up in our economic analysis. Excuse me. Taken up in our economic analysis, but it's an important issue of all public transparency. The markets can benefit from transparency, but it's sometimes there's somebody that had an advantage of the opacity. So when I was on Wall Street, we used to have a saying a little bit at the firm I was at, that darkness was our friend. And it was about sometimes opacity helps make more money as a dealer, but it's not necessarily the case that the markets themselves, economists tend towards the transparency helps the proper pricing in the markets and also helps capital formation.
Well, I'm delighted with your presentation. I understand with the little economic and finance that I handle at times, particularly with the stock market. Keep up the good job. Don't get discouraged. We'll get out of this mess in our financial markets.
Gentleman's time.
Thank you.
We'll now recognize the gentleman from Florida, Mr. Posey, for 5 minutes.
Thank you, Mr. Chairman. Good to see you, Mr. Chairman.
Good to see you, sir.
In spite of the SEC Inspector General and GAO recommendations, SEC continues to assert that as an independent agency, the Commission is not required to do the same kind of regulatory analysis and cost-benefit analysis as other agencies. Why is the agency so defiant about the suggestion to be accountable as other agencies are?
Well, actually, sir, we follow the mandate of Congress. In 1996, Congress put in our statute that we had to do economic analysis. And so we follow that. And then after a number of court cases in the early 20 years ago or so, we updated our guidance to ensure that we followed Congress's mandate. So we do economic analysis, again, sometimes measuring in a couple hundred pages. In every one of our releases, we get feedback from the public, and then we adjust, we modify.
So the Inspector General is wrong? You don't need to do any further analysis?
Well, in fact, we do need to do analysis because Congress mandated it. It's called, we have to analyze the efficiency, the competition, and the effects on capital formation. And in doing so, we lay out an economic baseline, and then we have to look at alternatives to the proposal, reasonable alternatives, and we look at cost and benefits. And so we do all of that.
And any rules are in conformance with the Administrative Procedures Act?
Yes, we do that in compliance with the Administrative Procedures Act, but also Congress added these other provisions in 1996. And as I say, after a number of court interpretations of that in 2005 and so forth, we updated how we did this. And we follow guidance that's been in place since 2012. So I think I'm the fourth chair that, we're following the similar guidance for 11 years now.
So does the Commission assess and analyze cumulative economic impacts of the rules that it makes and the interrelationship with other agencies?
We analyze in each one a baseline, as I mentioned. So if, for instance, there was an interaction and we finalize a rule, then we necessarily update the baseline for the next consideration for the world as it exists at that point in time.
All right. In your climate disclosure rule, are you requiring that firms pursuing ESG-directed investments also disclose the risks they face from favorable regulations not materializing or climate subsidies drying up or slowing down?
The proposal is really to capture the risks that investors want to understand. The proposal was about both the opportunities and the risks, but I think you did use this word. It's about materiality. we're not a climate regulator. We're really disclosure-based regulator, and thousands of investors, more than thousands, but representing tens of trillions of dollars of assets today are making investment decisions. And I'll share a statistic with you. Of the Russell 1000, the top 1,000 companies in the U.S., 81% currently make climate risk disclosures. 57% disclose their greenhouse gas, Scope 1 and Scope 2. And so what we're trying to do is just try to bring some comparability to that, in a sense, for investors, but also to avoid some greenwashing, frankly. So bring some comparability to that which is already happening.
Based on your strategic planning, which of your proposed rules is most vulnerable to the major questions doctrine set down in West Virginia versus EPA?
We really do everything we can to stay within the laws as Congress had passed it and how courts interpret them. We're familiar with the case, the Supreme Court case. It's the law of the land that you mentioned. And we take a very close look at that to ensure that when we finalize rules, it's within the laws and how the courts interpret it.
Are you trying to resolve any of those major questions at this time?
Well, I would broaden it out, sir. It's like any time the Supreme Court speaks to our broadly the administrative state's authorities, we take a look at that, and we take a look at every comment we receive from the public to stay within our authorities.
Gentleman's time's expired.
Thank you.
We'll now recognize the gentleman from Missouri, Mr. Cleaver, for 5 minutes.
Thank you, Mr. Chairman. Thank you, Chairman Gensler, for being here today. I'm one of those people who believes that there is such a thing as climate change, and the scientists, I agree with the scientists, I guess. Most of the warming that we are experiencing actually took place over the last 40 years. And the last 9 years are the warmest temperatures that we've had since modern keeping of the weather temperatures. And I'm from Kansas City, Missouri. The Missouri is the second longest water system in North America. It waterheads up in Montana, snakes its way all the way through Missouri, and then meets up with the Mississippi in St. Louis. It goes through 7 states, and the only reason I'm mentioning that is that we are experiencing all kinds of events along the Missouri River system. We had droughts, floodings are becoming more volatile, and weather events are becoming more extreme in impacting the Missouri River. And this becomes economical in the sense that the low water levels, which are reaching sometimes record lows, disrupts business. We do a lot of barge trafficking on the Missouri and the Mississippi, and that is being disrupted. And so the crisis puts into question our viability and long-term dependability. So I was pleased that in March last year that the SEC released the proposed rule to require public companies to make a variety of quantitative and qualitative disclosures regarding climate-related risk. Is there any company, any kind of economic interest in the United States that you think would be immune immune from climate risk as we are dealing with this? Well, we may not be dealing with it as powerfully as we should, but are there any exemptions that you can think of that would companies or corporations would not be impacted, or they're not, or not being impacted today?
Again, I understand your views. We're not a climate regulator.
I understand.
We're just, it's a matter of investors making investment choices. And for some companies, investors are getting disclosures, and we're trying to bring some comparability to that disclosures. Some companies, it's viewed as material, and some companies it's not. That's an important distinction, of course. But there's so many different sectors and so many different industries in this country, and we're merit neutral, but we're not disclosure neutral. And right now, 80+% of the top 1,000 companies are already making disclosures. It's really on our responsibility to bring some consistency and comparability for investors to get decision-useful information.
Yes, I'm not suggesting that you are the EPA or some kind of climatologist. I'm just wanting to make sure that the SEC continues to measure the impact through its disclosures of what's going on dangerously with climate change, and that it will all impact corporations.
I would say this. We have 16,000 comments. We have heard very consistently from investors that they find this information decision useful, and they would benefit from more consistency and comparability in the information they're frankly already receiving. So that's what we're focused on.
Thank you, Mr. Chairman.
Gentleman's time's expired. We'll now recognize the gentleman from Missouri, the chair of the National Security Subcommittee, Mr. Lukemeyer, for 5 minutes.
Thank you, Mr. Chairman. Chairman Gensler, my good colleague here, Mr. Cleaver, and I wrote to you in May regarding SEC's Conflicts of Interest Reproposed Rule, number 192, Prohibition Against Conflicts of Interest in Certain Circumstances, and our concerns about the potential treatment of mortgage insurance-linked notes. Now, our letter was filed under the bulk of all comment letters, and the first sentence asked for you to that we're requesting a clarification of the language that's in your rule. So we're disappointed with the interpretation of our letter, which is pretty plain from the standpoint we'd like to have an answer. But the mortgage insurers are a significant source of private capital in the housing and finance system, and these transactions are an important tool to reduce taxpayer risk, exposure, and cost. So question number one, do you agree that federal policy should encourage more private capital in the housing market, especially when it involves well-capitalized and highly rated entities?
Well, I think there are other agencies that are responsible there, but certainly our role at the SEC facilitates a mortgage market. We oversee, I don't know, $11 or $13 trillion mortgage securitization market, and what we are trying to do in that market, like other markets, is drive for greater efficiency and, as you say, opportunity for homeowners.
Well, the question is, can you be a partner with the private sector? So in other words, with reinsurance for these companies is very important to be able to allow the reduction, well, the spread of risk, and then, of course, the reduction of cost. The question is pretty simple. Would you support something like that?
I think that, if I understand the question, that mortgage originators rely also on mortgage insurance. That's an important part of it. That I agree. That's an important part of the market.
Okay. In our letter, we say that the rulemaking may unintentionally prohibit private insurers from procuring reinsurance via the capital markets through these MINs, which would negatively impact home buyers, lenders, and taxpayers. Are you considering changes to the rule to clarify the treatment of mortgage insurance-linked notes?
Without prejudging any adopting release, we're considering all the comments, including yours, but these individual letters you reference. Congress put a mandate that we had to help ensure that underwriters and sponsors of certain mortgage securitizations not be betting against their investors, and that's what we're trying to do.
Mr. Gensler, the letter should not be canned with the comment letters. It's a request for you to clarify what you're trying to accomplish here. And the letter to point out what we need clarification of. So we'd appreciate a response. Thank you for that. I also sit on the Chinese Select Committee. And as a result of my position there and my chairmanship of the National Security and Illicit Financing Subchair here, in 2022, the PCAOB inspection reports of mainland China and Hong Kong accounting firms, which audit U.S.-listed Chinese companies, were scathing and a reminder that financial statements produced by the CCP-controlled companies should never be trusted. Both reports showed unacceptable rates of Part 1-.A deficiencies, which are deficiencies so large that PCAOB staff believe the audit firm failed to obtain sufficient audit evidence to support its work on the public company's financial statements. Essentially, the audits were useless. Is it correct that under the Holding Foreign Companies Act, Accountable Act, these two firms, which fail so spectacularly, will not be inspected again by the PCAOB for another 2 to 3 years?
I'm not familiar enough with the PCAOB's rotating schedule, but it is accurate that when the PCAOB goes in to inspect an auditing firm in any country, they sometimes aren't able, they don't have the staff to go in on an annual basis.
Well, you know, the premise is correct there, where they only have to do it every 2 or 3 years. And so Mr. Sherman and I have introduced a piece of bipartisan legislation that require them to have an annual audit. These are very, as we saw in 2020, there were 1,000 companies on the exchange. Now it's down between 250 and 300. A lot of them are shell companies, and when we're threatened an audit, suddenly they disappeared. The funneling of our capital to Chinese companies and / the Chinese government and Communist Party has got to stop. And so we would appreciate your support for something like that. And just a quick comment, yes or no?
Look, I think it's really important. If somebody wants to issue stock in the U.S., they need to comply with their laws.
Gentleman's time's
particularly
expired.
China, that's very important.
Thank you very much. I yield back.
Gentleman yields back. The chair now recognizes the gentleman from Connecticut, Mr. Himes, for 5 minutes.
Thank you, Madam Chair, and thanks for joining us today, Mr. Chairman. I want to talk with you for 3 minutes or so about my ongoing efforts to codify insider trading into law, but I do want to take a minute here, since we're on the verge of a government shutdown, to just see how that affects you and your organization. It's sort of taken for granted around here that a shutdown is going to occur because my friends on the other side of the aisle can't find the coherence to pass a rule on the floor, much less do what we know needs to be done to avoid a shutdown, which is to pass a bipartisan continuing resolution. The Senate has figured that out. They're working on that. We'll figure that out eventually. In the meantime, to demonstrate the importance of doing that, we are going to shut down the government because of some MAGA extremists. Now, we get asked all the time about the very visible stuff. We'll be treated in the next couple of weeks to the sight of 19-year-old Marines and sailors lining up at food banks because they don't know that they're getting paid. SBA will be shut down. They will not be able to lend to small businesses, and those small businesses may go under. As we could go on with all the public stuff, but you lead an organization that has an awful lot of people who could be making a lot more money at a bank or at a law firm who are going to be told that they're inessential, who may be furloughed. So let me just give you a minute or so here. I'm curious, even though it's not going to make headlines, what would a shutdown do to morale and capability inside the Securities and Exchange Commission?
It's a remarkable dedicated staff, but we're looking at probably 90 to 93% of our staff will be furloughed. So we'll be down to skeletal 7-8% of our staff. In terms of what it would do for morale, I think that history shows, because we had one of these in 18 and 35 days at that point in time, that it's hard on people. It's hard because they're not getting a paycheck. It's hard because, as you rightly say, they can get jobs at law firms and elsewhere and go, and they're just really dedicated public servants. In terms of the markets, I would say if a company were deciding to go public or raise offerings, they'd want to go effective before Friday if they're ready to. If not, they might be in a sort of subliminal state where they can't access the markets because we can't effectively review those.
Let me redirect you for a second to, okay, companies raising capital, but your SEC is a whipping boy, you know that. But the truth is, the organization is full of people who are out there prosecuting fraud, who are stopping insider trading. Are Are we going to see, if there is a meaningful shutdown, fraud go unprosecuted, insider trading? You won't have the capacity to address these things, which hurt the American public, correct?
Yeah. While somebody can still file a tip, complaint, and referral, somebody can file a whistleblower, there won't be the people on the other side to really review it and investigate it.
Thank you. Okay, speaking of insider trading, Mr. Chairman, I want to just briefly discuss with you something I've worked on for 7 years right now, which, as you know, is trying to define insider trading in law. It's not defined in law today, as you know, and as a result, we have court-made law, Newman, Solomon, Martoma, overturning each other, creating a great deal of uncertainty, prosecutions being overturned, convictions being overturned, a great deal of uncertainty. I'm a believer in this idea that if we're going to send somebody for jail, we should be very clear about why we are doing that. So I'd love to get a minute or so from you, Mr. Chairman. Where are we? Would we benefit from a codified statute on insider trading law? Would that remove some of the uncertainty and remove some of the chance that the courts will overturn your traditional activities?
I think that we've had the benefit at the agency of robust, as you said, largely court-made law from the 1980s on, and you referenced some cases even in the last 6, 7 years. But I think we've provided you and other members, if I remember, technical assistance on a legislative package that you had last year, if I recall, that almost made it into the NDAA, if I recall. But again, I think that we have good, robust authorities, but the technical assistance, I recall, supported that bill. It supported what you were trying to achieve.
But ideally, and I think you gave us this technical assistance, if we could preserve those authorities that are legacy authorities, if you will, but if we could...
That was the key, that we didn't want to in any way lose the authorities that all the way up to the Supreme Court that we had.
Right, right. But I see you nodding. If we could codify a definition of insider trading and reduce some of the risk of overturning of case-made law, that might, in the long run, simplify your task and create confidence in the markets. Great.
Yeah, I think and again, we should follow up with staff, but our major concern was that we not somehow undo some of the really good law that's in place.
Gentleman's time expired. Gentleman yields back. The chair now recognizes herself for 5 minutes. Chair Gensler, while you were a professor at MIT, you spoke at length about how technology could be used to democratize finance. In fact, in a lecture quoted in a podcast entitled Paying It Forward with FinTech with Professor Gary Gensler, you stated, and I quote, "What I was drawn to at MIT was this sense that maybe we can democratize capitalism a bit more, that we can use technology to make finance more inclusive and more accessible to many more millions of people in our country and many more hundreds of millions of people around the globe. Now, sir, as chair of the SEC, you've put forward a predictive data analytics proposal that jeopardizes the innovation and technology that's made investing available to millions more Americans than ever before. I'm confused. At which Gary Gensler, the American public, should believe? The academic version, who spoke glowingly about the power of technology to help more investors participate in U.S. and global capital markets, or the SEC version, who apparently thinks all use of any technology by broker-dealers and investment advisors is inherently conflicted and firms should just stop using technology altogether. Chair Gensler, could you please briefly explain this change in your views?
I thank you for the question, a clever question. It's the same Gary Gensler. It's not my identical twin brother, Rob, or anything. It's me. And I believe technology is so transformative. I think artificial intelligence, machine learning is so transforming this decade and so forth. I think robo-advisors and brokerage apps, whether they're using these new technologies or some of the older predictive data analytics, just stand by that basic concept that the investor is first, not the investment advisor is first. That's all.
We agree there, and this proposal fails to acknowledge the already existing and well-functioning SEC regulations, such as Regulation Best Interest, Reg BI, and the fiduciary standard that protects investors. I would really urge you to withdraw this regulation, as we already have this in place. And during your last appearance in front of this committee, I asked you, sir, if you were planning to rewrite Regulation Best Interest, Reg BI, and you said that it was not currently on your agenda. However, the Commission's proposal on conflicts of interest associated with the use of predictive data analytics effectively rewrites Reg BI by holding broker-dealers and investment advisors to a higher standard of conduct and conflict neutralization than Reg BI. Were you intentionally withholding your plans to supersede Reg BI, sir, with a new proposal when you testified in April?
I feel the same as I did in April. I think this doesn't change Regulation Best Interest or the fiduciary interpretation. This does build on them in an important area around using predictive data analytics. If a function, an optimization function, it's a little bit of a math thing, but if the math is basically putting the investment advisor's interest ahead of the investors, if it's making a recommendation or it's giving a nudge, a behavioral nudge to steer somebody somewhere, therein lies a conflict. That's what we're trying to do.
It's too broad. I mean, we don't even know what technology would be applied here. And at the core, Reg BI has a fiduciary standard, the best interest, that is already there. You are now superseding that, and it's not just duplicative, it throws out potentially the fiduciary rule in Reg BI. So I again would encourage you, and I think we have bipartisan support to withdraw this rule just as soon as possible. And let me just ask you this question, since I have a limited time. How many staff, because this was a question I sent you that we haven't received response, how many staff with the Division of Trading and Markets and Division Investment Management and the Division of Economic and Risk Analysis were actively involved in drafting the predictive data analytics proposal?
I don't have a number, but I would say that generally speaking.
Do they have advanced degrees in computer science, data science, or engineering, sir?
A number of them have advanced degrees in economics and computer science, but I don't know how many of them do.
Well, I've sent you a list of questions. I'd love to have those answers. My time's expired. The chair now recognizes the gentleman from Illinois, Mr. Foster, for 5 minutes.
Thank you, Madam Chair. And I want to thank our witness for staying up until 9:30 p.m. to accept and analyze the just-in-time delivery of our bipartisan letter with 16 Republicans and 16 Dems on it that French Hill and I prepared. I want to make sure that you understand what the meaning of that letter is. It is not that you should stop working on the market reforms in parallel with 605 upgrades. Our intention is that you actually get the 605 done so that you have upgraded reporting of quality of order execution and so on, and have that in place so you can have a look at the data, then finalize the market reforms and watch, hopefully, the quality of order execution improve. And so just the meaning of the letter is to sequence those in that way, but not to cease all work on planning and so on of the market structure reforms. So just please read that, the end of the first paragraph carefully. One of the reasons it was late is we did a certain amount of wordsmithing to get that right. So, and I also want to comment a little bit on you were on. It was on your shift when we had the flash crash, right? And you were running the CFTC during the flash crash. And I remember when we had a hearing maybe 4 days afterward. The CFTC had, the night of the flash crash, 30 people with the entire trading history with that on their laptops figuring out what the heck happened. And 4 days later, the SEC, which did not have a consolidated audit trail-like structure in place, was still collecting the data to figure out what the heck happened. And so I think that is why we should not lose sight of making the consolidated audit trail, a success and really do it. And I think that's a separable discussion from the beneficial owner and cybersecurity issues there. And in particular, last time, one of the ways that I raised with you last time we were in front of our committee here, I asked you about the possibility of actually using the consolidated audit trail to simplify much of the reporting requirements under Rule 605, so that instead of making it a requirement of every one of the bazillions of companies that would have to do it, that you'd simply use the fact that the Consolidated Audit Trail has the information necessary to make a public report of quality of order execution for the different brokerages. That you could simply have either FINRA or some competent private subcontractor like S3 or similar, just have them write a piece of software that is run that provides this report based on the Consolidated Audit Trail. This would actually relieve the regulatory burden on a lot of the market participants and get something that was guaranteed to be, an apples to apples, well-defined comparison of the order of the quality of order execution. Have you had time since we spoke on this to have put thought into that idea and see if that's a useful way to simplify and speed up the 605 reporting?
One, I want to compliment you on your excellent memory of 13 years ago, and that when I was
it was seared in pain.
What's that?
It was seared in pain.
Seared in pain.
Like
It was the very next morning that the CFTC had all that information, and the SEC did not. In terms of you're raising an idea as to whether the Consolidated Audit Trail could be used for data about the quality of order execution. And though it's possible that technologists could figure and sort that through, that in and of itself would raise costs and benefits as well. And as everybody has encouraged us to always look at cost and benefits, I would just say currently market participants, brokers, can quantify their order quality. That's what this Rule 605
That's right, but then you have
measures.
to make sure it's an apples-to-apples comparison. They will have an incentive to not quite, if there's an ambiguity, they will resolve it in favor of making their numbers look good. You're going to have some of your employees looking over that. Whereas if you just say, okay, find a competent entity, like S3 seems to have a pretty good market share of doing that already, or FINRA, to just write one piece of software, make it public, run that piece of software in the Consolidated Audit Trail so that everyone understands exactly what numbers are being reported.
The one thing is the Consolidated Audit Trail does not capture and compare, the orders, like you bought something on a Tuesday, or you put an order in and here's the actual quality. So it would be bolting more requirements, I think, onto the Consolidated Audit Trail, but we can follow up and just talk further.
I think it actually could.
The gentleman's time's expired. The chair now recognizes the gentleman from Kentucky, Mr. Barr, for 5 minutes.
Chairman Gensler, have you ever spoken to Senator Menendez about the Securities and Exchange Commission's Director of Enforcement, Gurbir Grewal?
No.
On May 20th, 2021, your public calendar notes a call with Senator Menendez. What was discussed during that call, if you can remember?
2 years ago, sir, but if I recall, there was some discussion about possible disclosure by public companies of political contributions.
Well, you hired Mr. Grewal as the SEC's Director of Enforcement shortly after that May 20th call. Are you aware of the glowing statement in support that was put out by Senator Menendez praising your hire?
I thank you for letting me know that, but until you told me, or until today.
Well, I'm deeply concerned about this, and I'll be following up with your office with additional questions and expect a written response. Mr. Chairman, I really liked your colorful testimony, and you're right. We are blessed with the largest, most sophisticated, most innovative capital markets in the world, but we cannot take this for granted. Even a gold medalist must keep training. With all due respect, Mr. Chairman, if the U.S. capital markets are a gold medalist, you are the Tanya Harding of securities regulation, because you are kneecapping the U.S. capital markets with the avalanche of red tape coming out of your commission. On your climate disclosure rule proposal, you say that the SEC is merit neutral, that your focus on consistency and comparability of disclosure is not the merit of the investment. Sir, that is just not believable. The requiring Scope 3 emissions will lead to wildly inaccurate and immaterial disclosures that will be of little practical use to investors. They would also unfairly and inaccurately portray companies as major polluters that are, in reality have very low carbon footprints. Let's be honest, the agenda here is not to provide investors with relevant information, but instead to redirect capital away from fossil energy. Your proposal would discriminate against fossil energy, and you've repeatedly claimed that these disclosures are rooted in investor protection, but the largest U.S. energy exchange-traded fund is up 15% over the last 3 months. It's near its highest level in 9 years. How is it protecting investors to deter investment in profitable companies?
This is not doing that, with all respect. All it is about trying to bring some comparability to disclosures being made. We're not a climate agency.
I know. I've heard you say this.
We're really not.
But let's be honest. We know what's going on. We know what's going on. You're trying to scarlet letter fossil energy.
We're not.
I know you say you're not, but we got the joke. Everybody knows what you're doing. You're trying to redirect capital away. You're trying to discriminate against fossil energy, notwithstanding your protests. Most American investors find all of this Scope 3 emissions nonsense and immaterial. It's immaterial. I know institutional investors talk about this, but this is about an agenda to discriminate against fossil energy, which is profitable. That's not protecting investors. That's hurting investors. It's steering them into less diversified, lower performing funds. Let me move on to the perfect storm of regulations. Let me just move on real quick. Have you consulted with Vice Chair Barr about the Basel III endgame and the interplay between what you're doing on capital markets regulation and what's happening in commercial real estate? I'm very concerned about this because Basel III will increase the cost of credit, diminish lending capacity, and undermine the role that banks play in lending and financial intermediation in commercial real estate. Have you talked to the Fed about how this interacts with conflicts of interest and securitization rule, Rule 15C211, private funds, custody rule, and others? Because I'm really worried that Basel III endgame and all of your regulatory proposals would lead to a death by 1,000 cuts for commercial real estate when we're looking at maturities of $1.5 trillion in commercial real estate over the next 3 years. And it's not just about, refinancing from 3% to now 8%. It's now the fact that Basel III and then all of the non-bank activity is going to be sidelined as a result of the interplay between Basel III and your regulations.
We have ongoing conversation with the Federal Reserve about a number of our rules, but they have the lead on Basel III. That's not something we consult with them on.
All right. Well,
Gentleman's time has expired. I'd ask you to submit the answer to for the record.
The interplay is important. Yield back.
The chair now recognizes the gentlewoman from Ohio, Ms. Beatty, for 5 minutes.
Thank you, Madam Chair, and thank you, Chairman Gensler, for being here today. I am going to get to a question that I'd like to ask you on the proposal regarding predictive data analysis, but in light of the colorful questioning and use of language with discrimination and kneecapping, I want to ask you about the shutdown because I think my Republican colleagues are kneecapping the American people and those who serve this country and those that we took an oath to protect. And certainly, at least the last 5 government shutdowns have happened under Republican governorship. So you represent this large organization, and if there was a government shutdown, would that grind the SEC to a halt, yes or no, in your opinion?
We'd be skeletal staff.
And does that mean if there was a shutdown with your approximately 4,600 employees, you would be left with maybe only 400 employees who were not furloughed?
That's correct.
And those remainder would be furloughed without pay?
Yes, that's correct. Even those that are working would be without pay.
Right. And these are hardworking American people with families and children that would considerably, in my word, be kneecapped by my Republican colleagues who have so much concern about what we're doing. And so would that have some effect on the registration statements for new users and offers of securities and surveilling the functionings and operations of capital market?
I think you could say largely the initial public offering market would be shut down with the government.
And would you say investors would be vulnerable to fraud and businesses will be deprived of their opportunity to access capital markets?
I would say that while we'll have a skeletal staff, it will be hard for us to oversee the markets.
And that's what you're charged with doing. Like, we're responsible for keeping the government open and protecting the American people. You probably would agree with that. I'm not going to ask you to answer that. So now let me get on to my question after I feel a little renewed letting the American people know that while we're here, we can ask all kinds of questions, but if we want to talk about economic analysis, if we want to talk about threats of subpoenas for not being direct, let's talk about what's happening to the American people in real time. But with that said, I'm going to give you an opportunity to talk about this proposal that we've heard a lot about. I understand that the proposal is currently very broad in scope, covering the range of investor interactions, including communications through covered firms' public websites. There is concern that it could even encompass financial education tools for investors, and it could cover things such as an application that analyzes an investor's future retirement assets by changing the inputs for different mixes of assets. Can you address the concerns or take the rest of my time to talk about this proposal so we can understand it better?
Well, this is one thing I'd say. This hearing comes at a timely moment because the comment period is open until October 10th on this particular rule. But this rule really has a basic concept that if you're engaging with investors, that those investors' interests come before that of the investment advisor or broker-dealer. And if you're using predictive data analytics to determine how to nudge them or guide them, you should be not putting your interest. Look, in my downtime, I like to watch romantic comedies and watch on streaming apps. If the streaming app figures out that I'm like a rom-com guy, which I am, and they're doing it because they make more money because I watch the streaming app more.
There you go.
All right. But in finance, if you're doing it and you're nudging somebody to trade more and churn up their hard-earned assets, or to nudging them to margin or options trading or higher fees on a robo-advisor, and it's not in their interest, but it's in the investment advisor's interest, therein lies a conflict. That's what we're trying to address.
Thank you.
Gentlelady's time is up. Gentlelady yields back, and the chair now recognizes the gentleman from Texas, Mr. Williams, for 5 minutes.
Thank you, Chair. The SEC's recent climate rule proposal was 500 pages of mandatory disclosures that will now require companies to report on emissions data and climate risk management strategies. This proposal is a major concern for business owners back in my district who are worried. I'm a small business owner also about the SEC's recent push to implement costly environmental, social, and political regulatory requirements. They're not even relevant to the company. So the SEC's proposed climate requirements will cost companies millions of dollars to ensure they are properly compliant with these burdensome rules. This will force business owners to hire more lawyers and compliance officers rather than investing back in their employees and operations, which would help their businesses grow and bring more in revenue, and I've seen that happen in my business. So businesses are already struggling to operate within tight margins, and an increase in compliance costs could be their tipping point. And on top of that, the Scope 3 emissions disclosure will direct companies to speculate on the emissions output for their suppliers and products, which require substantial information to get a proper estimate. So this could lead to smaller businesses being left out due to how difficult it is for them to obtain this complex information. And the SEC crusade is extremely out of touch and exceeds their intended missions and statutory authority. So the SEC needs to stop their abuse of the rulemaking process before they cause any further damage to the industry. So, Mr. Chairman, What is the average amount of time and resources everyday companies will need to ensure they are properly complying with the excessive climate risk disclosures? And how can mandating companies to file on indirect emissions relating to their company provide consistent information for investors?
Again, and Mr. Boer, sitting behind you, asked a similar question. Let me just put it in context, if I may. Investors today are making investment decisions based on climate risk disclosures. We're trying to bring some comparability. Both you and other members have raised this question about greenhouse gas emissions, so-called Scope 3. And for the listening public, this is of the value chain. It's not about the company itself. It's about their suppliers or their customers. And we got a lot of comment in the public file about this, not just from members of Congress, but from small and medium-sized enterprises in your district and other districts, from farmers and ranchers and the like. We're taking a very close look at this. Our remit, our legal authority is about public companies. It's about the public companies. And over half of the top 1,000 already making disclosures around their emissions. But we understood even in the proposal that so-called Scope 3 is less developed, is less used, and we got a lot of feedback, and we're taking that under consideration and looking at it very closely.
Because when you make small businesses smaller because of regulations,
yeah, and let me assure you, sir, and I've said this in a Senate hearing 2 weeks ago as well, our remit is just about those public companies. It's not the private companies in your district. My dad had a very small company, too. That's not the remit of the SEC.
All right. The SEC's rulemaking process is unprecedented, proposing over 50 rulemakings since the spring of 2021. The SEC has failed to understand the impact of these rules and how they will each affect the industry, as well as the aggregate amount or impact. It is crucial that the SEC conduct cost-benefit analysis and solicit industry feedback of these proposals and what it will cost for the participants that the Commission oversees. I was proud to sign on to a letter led by Chairman McHenry to you, highlighting our concerns with rulemaking agenda and substantial volume. It's vital that the SEC understands the regulatory and financial burdens that they are unjustly placing on market participants, just like we talked about. So, in closing, Chair, has the SEC engaged in any roundtables, field hearings, or investor testing to really solicit feedback before rulemaking?
Again, it was good to read your letter about 8 p.m. last night. It was a good letter. But in terms of your question, we solicit feedback in the formal way through the comment period. We solicit feedback and have hundreds of meetings, sometimes on any one rule, with market participants, and then we detail them in the files, and we benefit from that feedback.
Well, thank you. I yield my time back.
Gentleman yields back. The chair now recognizes the gentleman from California, Mr. Vargas, for 5 minutes.
Thank you, Madam Chair, and I want to thank the chair and the ranking member for giving me the opportunity to speak. And I want to say, Mr. Chairman, it's good to see you, but I have to say it was even better to see Chairman Lucas. Chairman Lucas was the chairman of the Agriculture Committee when I first came to Congress 11 years ago. He was eminently fair and a good person to work with. And we have an 1,800-pound bull on our property, on our ranch. And I got to tell you, don't mess with those animals. Those are big animals. They can do a lot of damage. So it was great to see him here today. Like I said, I think everyone on this committee has great respect for him. But it's great to see you here. You were asked somewhat of a catch-22 question earlier, and that was you were supposed to produce some documents, and within those documents was a letter that was, given to you by this committee. And then in that situation, it's either you disclose that letter is in there, and they say, aha, you disclosed the letter that we sent you, how typical. Or if you didn't, you'd say, boy, you didn't even disclose the letter that we sent him. So you were sort of caught in a catch-22 no matter which way you answered. I'm glad you disclosed the letter. But then you were asked, I think, a very ugly and unfortunate question about a recent senator and your interactions with him because he's been indicted. I think there was an insinuation there that maybe that something that you did was inappropriate or improper. Could you comment on that, please?
Well, I can't comment about a criminal prosecution.
No, not about the criminal prosecution, but the insinuation that you possibly did something that was inappropriate in your conversation with him on the phone.
Oh, no. I mean, I didn't discuss anything with the senator in May of 2021, except for his concerns about federal securities laws and disclosure, if I recall, but there might have been other topics that he talked about around disclosure around diversity by investment advisors.
Yeah, I just wanted to give you an opportunity to say that because, again, I think that was a bit of an unfair question. And so,
in a role like mine, I engage with senators and members of the House of Representatives, and we benefit from those engagements.
Yeah, no, I agree. But again, thank you for being here and thank you for answering that question. Now, I take a very different view of climate-related risks, of course, on this side, and I think it is one of the biggest issues that we face as a world and certainly as a country. And the reasonable standard, again, was created by Thurgood Marshall, and that is the reasonable person, the materiality. What would a reasonable person want to know? And it seems to me with all the headlines that we have and all the information that we have about climate-related risk, and I could go through a whole bunch of headlines here, which I won't, but it seems to be that this is a gigantic issue and people want to know, and in fact, people do want to know, and companies have been disclosing this for a while. So I think you're on the right track. But you're not a climate change organization, are you? You're not the cop on the beat for that.
No, we're a securities regulator and disclosure-based regulator, and that's what we're trying to do here is just, as I've often said, investors are making decisions today about public companies based on their climate risk disclosures, and it's trying to ensure that it's truthful, it's accurate, it's decision useful.
Yeah, and in fact, this is what people want to know today, isn't it? I mean, any investor today that reads the newspaper, especially if they're invested in insurance or a company like that, they say, well, why isn't my company, insuring in California or along the areas in Florida that get swamped all the time with these huge hurricanes? Well, it's because of climate change. And now, interestingly, we used to have climate deniers say that, no, we have the scientist that says that climate change isn't real. Now, basically, all the climate scientists, all the scientists agree. Now, you got some knuckleheads that are column writers that say, this isn't true, but it's not a scientist. Serious scientists don't dispute it anymore. And it's real, and it's a big deal, and I'm glad you guys are looking into it because investors want to know about this, especially long-term investors.
I would say from the SEC's perspective, it's about whether investors are making investment decisions and find it material, as you mentioned, the Supreme Court law of the land, that a substantial likelihood that a reasonable investor finds it significant in the total mix of information. And that's what we know to be the case today. If 80+% of the top 1,000 companies are making some climate risk disclosures, they're not all making Scope 3. We had lively discussions about that. But in terms of climate risk, a lot of companies are making disclosures already.
Well, thank you again for being here. My time is up, so my last 7 seconds, I thank the chair again. Thank you, Mr. Chair.
Gentleman yields back. Gentleman from Minnesota, the whip, Mr. Emmer, is now recognized for 5 minutes.
Thank you, Mr. Chair. Chair Gensler, I have a series of questions that require a yes or no answer, and in the interest of my limited time, I'd appreciate it if you would comply with that. Mr. Gensler, is it fair to say generally that large institutions in any given industry benefit more from regulatory uncertainty than everyday market participants or smaller institutions who don't have the scale or the capital to fund expensive compliance teams?
Large institutions could benefit from uncertainty.
Reclaiming my time. The answer is yes, sir. Mr. Gensler, you had an 18-year career at Goldman Sachs where you were partner and co-head of finance, correct?
Yes, sir.
Thank you. And is it correct to say that you made most of your personal wealth directly through your employment at this bank, Goldman Sachs?
I've done well since then, too, sir.
I'll take that as a yes as well. You described the SEC under your leadership as the cop on the beat watching out for our constituents, correct?
I think that's a mandate that Congress
and I
has
think
given
you've
us.
said that, reclaiming my time. The answer is yes, sir. If you could just comply with what I've asked, I'd appreciate it. But given your 18-year career at one of the biggest banks in the world and the personal financial fortune you amassed there, do you think it's possible for you to serve as an impartial regulator and not favor large financial intermediaries?
Absolutely, sir.
Well, Mr. Gensler, do you believe the vast majority of digital assets meet the investment contract test and are therefore securities operating illegally outside of the U.S. regulatory umbrella?
As I've said, many of these assets are basically the public is anticipating
Sir, is
profits
that a yes?
based on the efforts of others.
Is the answer then yes?
Again, without prejudging anyone, I do think that the significant
Reclaiming my
majority
time.
are
I'll take it as a
investment
yes.
contracts.
And to be clear, sir, this perspective has nothing to do with a concern you noted in a speech last year where you said, quote, "Over the past year, several bank executives have shared their concerns with me about the sheer number of depositors who have moved money from their bank accounts into crypto-related exchanges and wallets," end quote. Right?
The concern that those bank executives raised was that there's
Again, I'm reclaiming my time,
customers
sir.
were getting
No,
hurt.
I've asked you to answer the questions as short as I can so I can use the time I have, and it's clear that you would like to avoid answering the questions, in my opinion. An Obama-appointed judge in the Southern District of New York, a bank-friendly jurisdiction where you bring most of your cases, recently found that decentralized financial technology, quote, "not only removes the so-called middlemen from these transactions, but it also allows users to interact through a variety of methods in an easy and efficient manner," end quote. The court also said underwriters, like the ones at banks where you work, sir, are, quote, precisely the types of individual roles that decentralized exchanges were designed to eliminate, end quote. Mr. Gensler, can you assure this committee that your style of regulation by harassment towards digital asset innovation is to the benefit of every American and not driven by your desires to protect industry incumbents?
This is a field that's rife with fraud and manipulation, and I'm looking out for the American investors who've been hurt by the crypto.
Yeah. I'll reclaim my time. Mr. Gensler, despite your years of rhetoric, like today, I'm convinced you are not an impartial regulator. Instead, it's clear that you are working to consolidate your own power, even though it means crushing opportunities for everyday Americans and, frankly, the financial future of this country. Even the federal courts are highlighting the damage you, sir, are doing to our constituents, and they're telling you that you don't have the legal authority to accomplish your goal of squashing competition in the financial markets. Congress has been telling you that too. Now, Mr. Gensler, I believe our great financial system is the definition of freedom in this country, and congressional policies must provide room for the traditional financial system to evolve alongside the disruptive digital asset ecosystem. That said, it cannot be understated that a common theme throughout your career, sir, is your relentless loyalty to the largest financial institutions at the clear expense of innovation, competition, and everyday Americans. I yield back.
I suspect some large financial institutions would not agree with that.
There's no question, sir. I've yielded back my time.
Gentleman yields back. Gentleman from New Jersey, Mr. Gottheimer, is recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Gensler, Shana Tova. It's good to see you.
Shana Tova, may this year bring you health and happiness.
You too, sir. If I can begin, in your testimony, you said that it generally takes 12 to 24 months for the SEC to proceed from issuing a new rule proposal to adopting it as a final rule. That may seem like a long time, but I assure you, as it's not a very long time for some of the smaller stakeholders that I speak to, about who are spending so much of their time and resources and running their business and trying to compete. And of course, you know, I'm getting concerned, and I wanted to get your thoughts on this as well. Are you worried at all that all these rules are putting smaller and medium-sized businesses at a disadvantage and inadvertently benefiting the larger ones that can better handle the deluge of all the proposals? So is there an unintended consequence of actually limiting the flow of capital to smaller and medium-sized businesses and favoring the larger ones?
And we've talked about this in your office as well. I think that we benefit hearing from those small businesses. We often then look to adjust the rules based on those comments, and also, if the rule is adopted, the implementation and compliance dates. And sometimes we stage that, whether it's over 12 to 24 months and the like, after a rule is adopted.
Part of my concern is, and I appreciate our ongoing discussion on this front. By my count, you've issued 50 separate rules, and there are another 14 new rules on your most recent unified agenda that are scheduled to propose in the coming months. And I'm just trying to figure out the volume, what this means for the smaller stakeholders, and they just don't have the back end, the regulatory back end to be able to engage with the SEC and don't know how to engage with the SEC in some ways. How do you think about that? How are you trying to shape the agency to really allow for them to also have a fair shot at comment period?
Well, in part by putting out the agenda itself 2.5 years ago. We've now proposed the bulk of that. working through. We take meetings even after comment periods, all the way up to sometimes a few weeks before we adopt, and so to keep engaging with us, and certainly if there's not a shutdown, we're here, we're ready to take those meetings.
Yeah, I just hear sometimes just so you should know, just some feedback that they often feel they don't know how to come into the agency, how to utilize the agency, that it can be intimidating. Especially if you're a smaller player, you just don't know really how to do it, and they don't have these big regulatory teams.
I would say that sometimes those are the best meetings. They're not necessarily the meetings that show up on the calendar as much, but they really are very helpful to hear from those smaller asset managers, those smaller broker-dealers, or public companies.
I'd like to shift gears to digital assets. In July, I was proud this committee passed comprehensive digital asset legislation, bipartisan, including my amendment directing the SEC and CFTC to do a joint rulemaking, creating a process for delisting an asset. Since 2019, I've said that clear rules of the road for digital asset firms are critical to protect consumers and promote innovation here in the United States. You've claimed that you have all the authority you need, I know before us, but a rulemaking process hasn't started yet. Can you explain to us why, please?
Well, because there's already laws and rules in the books. There's rules and laws in the book that apply to crypto security tokens like they apply to others. And there's nothing incompatible because you're storing something of value on a blockchain ledger. We talked earlier about being technology neutral. Whether you're storing that at DTCC, the public clearinghouse, or you're storing it on an accounting ledger called blockchain, it's still a transfer of value, and the public is maybe, depending on the token, anticipating a profit based on the efforts of others. As it relates to the so-called crypto exchanges, they're doing what we wouldn't even allow anywhere else. They're commingling, co-bundling, trading against the public, and sometimes front-running the public on their platforms.
So memorandums of understanding have long been used and adopted in a number of contexts. In June 2022, you told the Financial Times you were working on an MOU with the CFTC to avoid regulatory gaps for crypto. Can you give us an update on the status of the MOU, please?
I was hopeful that we would do something there, but what we do is on a case-by-case basis and issue-by-issue basis work with the Commodity Futures Trading Commission with regard to this crypto field. They have important authorities. They execute against those authorities. We do against our authorities, really both with the same goal of protecting the public.
Thank you, May. Have a sweet new year. Thank you.
Gentleman's time has expired. Gentleman from Michigan, Mr. Huizinga, is recognized for 5 minutes.
Thank you, Mr. Chairman, and good to be back. I was out of order here because I was in a bipartisan meeting with the Speaker talking about a debt commission, and I hope that that is going to be part of the path forward that we are dealing with government funding and our long-term debt. But I want to move quickly, but I want to follow up on some of Chairman McHenry's line of questions and remarks. And I'm not going to belabor the whole situation where we've had public documents that you've given us on our request that's been out there for over 7 months. No real information except for that which was FOIA'd by the public. Our request simply seeks to obtain information to better understand the black box of the SEC's activities on climate-related measures and its rulemaking authority. And you had said in your own remarks, quote, based on authorities granted by Congress. Well, I dispute the assertion that you've been granted that authority in this particular case, and we are a co-equal branch of government, and this is routine congressional oversight. So let's talk a little bit about the commission vote for the climate request. When Chair McHenry asked, have you scheduled a vote for the commission? I did not hear an answer on that. Or when will a vote be scheduled? I did not hear an answer on that. There's 13,000 emails and documents we've been told that are ready to be produced, but are being held up by a provision within the Exchange Commission, 24C, Exchange Act, sorry, I should say. It requires a vote of the SEC commissioners, is your assertion, or the commission's assertion. Lawyers differ on that, and it's my understanding that you claim that you don't have the votes necessary on the commission But, Mr. Gensler, I want to ask you this. Are you personally ready to vote yes to produce these documents to this committee?
We continue to work with your staff and continue to work. We have voted as a commission on I think they're called transcribed interviews of...
This transcribed interviews are very different than the documents that we have requested. I'm asking you, not about the commission. Are you voting yes, and will you vote yes on giving that information to our committee as requested?
Again, as I've said, I truly believe in the oversight of this committee.
Yes.
Working with the committee to
yes or no?
Working with my fellow commissioners, and
I want to know what you are going to do, not speaking for anybody else. You.
Again.
Yes or no?
Sir, again, we're working through this at the commission level.
Come on.
And with,
all right,
with your
this is
staff.
ridiculous. Okay, so let's assume your answer now is no. So what have you done to try to produce a vote of any sort? Are you talking to your fellow commissioners? Are you whipping them? Are you asking them to vote for that?
We have ongoing discussions. We, of course, have to have it one-on-one
Okay.
because of the Government and Sunshine Act.
All right. Frankly, we've been pretty cloudy over here on the congressional side. I mean, you're fulfilling FOIA requests, but you will not give that same information to Congress. That's a problem. So under 24C, the delegated authority by the commission allows you to do those FOIA requests without a vote of the commission. Seems to me maybe we need to help you out. Does that seem reasonable? Because here's our problem. What happens if you never get the votes? What's your plan? Ignore Congress?
We're going to continue to working with you.
What is your plan? Because we've got a plan. The chairman outlined the plan. And it begins with a P and ends in oxy, and it's not a real fun word that any of us want to fulfill.
Again, we're continuing to work and trying to get you documents on a regular basis.
But you are not. You are giving us publicly available documents. That is not the role of oversight. So, okay, so are you open to legislation that would clarify that the SEC is not required to have a full commission vote to comply with the requests for Congress or in Congress or this committee?
Again, I'd have to have staff look at the legislation. We'd give technical assistance as we give it on other provisions.
Yeah, I'm pretty sure we don't need your technical assistance because so far the technical assistance has gotten us nothing. So, I enthusiastically support the chair's discussion of using compulsory process. And it's shameful that you're hiding behind this 24C process and that the commission is. And we are going to have to remedy that, apparently, based on your lack of cooperation. One last quick question. Did you ever receive a memorandum or agency document in writing assessing the Supreme Court's decision on West Virginia versus EPA on the SEC's rulemaking authority?
I know that we've had discussions. I don't remember any memo. I've read.
I'm going to ask you to follow up. My time has expired.
Gentleman's time has expired.
We're going to have you follow up in writing with that, Mr. Chairman. I yield back.
Thank you.
Gentleman from Illinois, Mr. Caston, is recognized for 5 minutes.
Thank you, Mr. Chairman. Nice to see you again, Secretary. I want to talk about your climate disclosure rule. I know that surprises you that I want to talk about that. And I realize that with it coming out soon, I'm not going to be able to get into specifics, but I do just want to expand a little bit. You had mentioned to Mr. Cleaver that investors were asking for more clarity because of all the voluntary disclosures that are out there. And I think, but I don't want to be presumptuous, that there's some history there that I'm hoping you can share, because I think in 2010, SEC drafted sort of interpretive guidance regarding more voluntary disclosures. Can you clarify what happened between 2010 and then 12 years later in March of 22 when the SEC decided that it was necessary to provide some more disclosure, and specifically if you can comment, like, what was industry asking you for?
So a lot changed in the 12 years. Particularly, investors got more and more interested making investment decisions. And here in the U.S., companies responded. Their investor relations and their CFOs and corporate executives responded to meet those requests by investors. And they started following something that was called the TCFD framework. You're probably familiar with this international framework, which interestingly was 32 people that were mostly from industry. They weren't government sector that came to this framework. And so by 2021, 80+% of the top 1,000 companies were making some climate risk disclosures. That's what really changed. Investor demand for investor decision-making, and that's where the SEC has a role.
Well, I appreciate that. That certainly is consistent with my experience in the private sector, and I think it's said that we need to keep reminding folks that this was a really industry-led initiative in the first instance. I want to move to the state level because a little while ago you had mentioned to the Wall Street Journal that if California finalized some rules, I think your quote was, you said, this may change some of the economic baseline of the commission as it relates to the pending order. And of course, last month, the California legislature did pass a package of climate disclosure bills, which I understand only relates to companies beyond a certain size that do business in California. But given your earlier comments, can you speak to how, if at all, that is factoring into how you're thinking about the disclosure and whether you're still on pace for an October release, as you'd earlier indicated?
So in terms of, we look at the economics very seriously, and that law that was passed in California is not yet signed, but if it were signed into law, as I understand it, that would require companies of a certain size to report on their climate risk, I think over $500 million in revenues, and those over $1 billion in revenues to report greenhouse gas emissions. And for the listening public... And
on a Scope 1, Scope 2, and Scope 3 basis, it's worth pointing out.
All three of these scopes. But for the listening public, it's estimated that somewhere between 1,400 and 1,500 public companies might need to report under that law. We have not confirmed that number. That's just an estimate that's in the press. And so that may change the baseline. If those companies were reporting to California, then it would be, in essence, less costly than because they've already been producing that information. It's also important that the investing public, again, because they're making decisions based on those public reports, that they're accurate, that they're truthful, because the investing public benefits making sure that the accuracy of the disclosures.
And you had indicated that you were targeting an October release date for the final rule. Are you still on that pace? Can you speak that? And does California's actions in any way change that?
Let me just put this a little in context. Twice a year, working with the Office of Management and Budget, we put out what's called a unified agenda, and we put dates on all of the proposals really in 2 different dates of the year. So I wouldn't, with all respect, put too much emphasis on that. Fair. It's really with 16,000 comments. We've gone through, it's 15, 16 months since we made the proposal. It tends to take, again, 12 to 24 months. But we're not doing this against a clock. When the staff's ready, when the commission's ready.
Thank you. Got more questions, but I'm out of time, so I yield back. Thank you again for being here.
Gentleman yields back. We'll now go to the gentleman from Georgia, Mr. Loudermilk, for 5 minutes.
Well, thank you, Mr. Chairman. Chairman Gensler, thank you for being here. Mr. Chairman, without objection, I'd like to submit for the record a Wall Street Journal article by Warren Stevens and Paul Riley entitled, "The SEC Wants to Spy on Your Portfolio."
Without objection.
Thank you, Mr. Chairman. Chairman Gensler, as the op-ed points out, prior to the consolidated audit trail, the government needed legal cause to force financial institutions to report their customers' personally identifiable information. In your opening statement, you refer to the SEC as cop on the beat. But law enforcement has to comply with due process. And I'm convinced that the consolidated audit trail has the potential to become another warrantless surveillance program. And as we have all experienced, if you extend the government power, that power will inevitably be abused, as we saw with the FISA courts, especially if that power does not have direct oversight and control by Congress. My first question, Ms. Gensler, have you read this article? The Wall Street Journal just came out the other day about the consolidated audit trail.
I may have. I feel like it's in the last 2 days. I saw the headlines.
All right. So it goes on to explain the problems that I've laid out several times when you've been here before about the collecting of personal identifiable information and, quite frankly, a lot of information about individuals and their buying of stocks. In fact, when you were here last time, I believe that you expressed the purpose of this is so you could peruse to look for any potential illegal activity. That's a blatant violation of the Fourth Amendment. That is what this article is spelling out, and it's gotten the attention of a lot of people, even outside the financial services arena. So I would encourage you to please read it because I think it explains the concerns that many of us have about this program. Also, Mr. Chairman, I'd like to submit for the record a letter that was sent by me and my colleagues to Mr. Gensler regarding the Consolidated Act audit trail.
Without objection.
Thank you, Mr. Chair. And Mr. Gensler, regarding this letter, in the letter I ask about the 3,000 individuals, estimated number of people or institutions that would have access to the Consolidated Audit Trail or the Customer Account Information System. 3,000 would have access to it. Who are these individuals, and how will they be vetted for access to such sensitive information?
One, I do look forward. I will read the article that you mentioned. Two, in terms of individuals, it's only allowed to be used, this Consolidated Audit Trail, at the SEC and the self-regulatory organizations. At the SEC, it's our Division of Enforcement, our economic risk analysis, folks in our trading and markets.
How are they going to be, how are all these, 3,000 individuals getting access to personally identifiable information and details about stock transactions by even just a factory worker who has a Robinhood account? What's the vetting process on this? And how are we going to be ensured that they do not use this in violation of personal rights?
I just want to say I'm not familiar with that number, but in terms of at the SEC, these are people that are dedicated public servants that are full-time at the agency, either in our enforcement, our economic risk, our trading and markets, the market surveillance.
Well, if you'd respond to the letter, that may be helpful. And I'd like to move on because we are getting short on time. This really just a yes or no question. Will the SEC use data collected via the Consolidated Audit Trail and the Customer Account Information System to bring enforcement actions?
We have already. We will anticipate in the future.
So let me make sure I've got this right. Well, let me ask you this. How has it been funded, the Consolidated Audit Trail? Is this being appropriated by Congress?
It's by industry funding.
Okay, so private industry is funding this, which the cost of this has gone up exponentially since it started. But this, just to close out, I want to make sure I understand. You're saying that the Consolidated Audit Trail is a comprehensive database of transactions used for federal enforcement purposes, but it is not subject to congressional oversight or through appropriations. I mean, this is lining up to be another surveillance program without any control, without any constraint, without even the power of the purse. And I yield back.
Gentleman's time has expired. We'll now go to the gentleman from New York, Mr. Torres, for 5 minutes.
Thank you, Mr. Chair. Mr. Gensler, good morning. I worry that the term investment contract has become so infinitely malleable and manipulable that it means whatever you unilaterally thinks it ought to mean, right? I worry that when it comes to crypto, your interpretation of the term investment contract has no limiting principle and therefore could invite arbitrary and capricious enforcement action. So I want to take a few minutes to explore the concept of investment contract in greater depth. And I want to start with an obvious definitional question. We know that an investment contract requires an investment. Does an investment contract require a contract?
You know, something about this definition, I will quote Thurgood Marshall, Congress painted with a broad brush. And when Marshall said that, he was writing the law of the land. So we follow this Howey test and how not just Marshall, but other courts interpreted it. And it has a four components.
Again, I did not go to MIT, but in the Bronx, if I ask whether an investment contract includes a contract, the answer is typically yes or no. So,
actually, sir, under the Supreme Court law of the land, they do not write that in. They say it's investment of money in a common enterprise when you're anticipating profits based on the efforts of others. So I took an oath to follow the law of the land, and that's the Supreme Court law of the land.
So in Howey, the Supreme Court refers to an investment contract as a contract, scheme, or transaction. That was the terminology that I saw in the case. And as far as I can tell, there's nothing in the Supreme Court's jurisprudence that suggests that a scheme or transaction means the absence of a contract. And so by way of illustration, consider the landmark case of SEC versus Howey. In the Howey case, there was not a single contract, but there were two contracts. A land sales contract with the Howey Company and a service contract with Howey in the Hills. And the court found that the combination of those two contracts, the total scheme, the total transaction, the total economic reality, was constitutive of an investment contract. And so a scheme or a transaction does not mean the absence of any contract at all. It means, as it did in Howey, a multiplicity of contracts. In August, there were 6 law professors from law schools as preeminent as Yale who came to the following conclusion, quote, "No decision of the Supreme Court has ever found that a scheme that does not involve a contract could qualify as an investment contract." And so do you disagree with that statement? And if so, could you please cite a decision of the Supreme Court that has found an investment contract in the absence of an actual contract?
The SEC has been in front of multiple courts, and investment contract has been...
What's the name of the case, Mr. Gensler? The Supreme Court case that has found an investment contract in the absence of an actual contract. Do you have the name? Can you cite a case?
The SEC over the decades, whether it's
Can you cite a case?
Whether it's whiskey caskets, whether it's crypto, if the public is investing based upon the efforts of others...
I find it telling that you cannot cite a single case.
That's a security.
Not a single... How about a Second Circuit case? Can you cite a single Second Circuit case that found an investment contract in the absence of a contract?
I understand where you're trying to go, and I'm going to leave that to the very fine attorneys at the SEC in front of courts. But I'm saying the core principle
Mr. Gensler,
this is a field...
Let me finish. This is a question to which you should know the answer, because the definition of an investment contract is the central issue. That's what determines the extent of your authority. That's what determines the applicability of federal securities law to crypto transactions. And your inability to answer that question is baffling to me.
I'm answering it consistent with what the Supreme Court has said, which is the law of the land is a 4-part test.
And yet you cannot cite a single case to support your argument.
It's called Howey, it's called Reeves, it's called many cases at the Supreme Court, sir. 8 or 9 times it's been affirmed by the Supreme Court.
Can I ask, suppose I were to purchase a Pokemon card. Would doing so constitute a security transaction?
You could purchase a Pokemon card. I don't know what the context is, but if you're just purchasing a Pokemon card...
If I purchase a Pokemon card, is that a security transaction?
Store, that's not a security.
Okay. If I were to purchase a tokenized Pokemon card on a digital exchange via a blockchain, is that a security transaction?
I'd have to know more.
Okay. So for you, the process of tokenization is what transforms a non-security transaction into a security transaction?
Look, if the investing...
I thought you were technology neutral.
If the investing public is anticipating profits based upon the efforts of others and they're exchanging funds, that's the core...
I see my time has expired, so...
Gentleman's time has expired. Well, I'll go to the gentleman from Ohio, Mr. Davidson, for 5 minutes.
Chairman Gensler, recently a federal court called your rejection of a Bitcoin ETF, quote, arbitrary and capricious. In a subsequent interview, you dismissed the judge's opinion. Asked a follow-up question, if anything a judge says would change your mind, you responded, quote, well, no, not really. It seems that you don't really recognize the authority of the judicial branch. You seem to have a love for the Howey test, selectively applied as illustrated by Mr. Torres. But, in light of those reactions, what should people make about the Bitcoin ETF? How will the SEC revise its approach?
We have great respect for the courts. I personally have great respect for the courts. We're considering that. It's still an active consideration at the commission. And
so you haven't made up your mind? I got to tell you.
We're familiar with the case.
Yeah, I got to tell you that many market participants have reached out and are concerned that you will arbitrarily, perhaps also capriciously, pull recent filings ahead of others who've been working with the SEC for years to get an approval for a Bitcoin spot ETF. Will this resemble some sort of free pass for one favored company while others remain locked out? And I ask that because it seems that's happened before at the SEC.
Sir, I'm not sure if I'm following. I mean, we're still considering that court case and the application, as you say, to Bitcoin exchange-traded products.
Are you going to preserve people's place in line, or are you going to pull ahead a favored transaction or another on the consideration of a Bitcoin spot ETF? Are you going to preserve the place in the queue? Because timing matters. People have worked on this for years, and then you get a recent filing by somebody big in the market, and it seems like, oh, yeah, let me take your calls. How can I help? Meanwhile, you've given the stiff arm, as I've said, Hotel California-style regulations where you can check in with the SEC, but you can never leave. Never leave with clarity. And how about the legislative branch? Do you recognize the authority of Congress or the laws that we pass?
Yes, we comply with the laws that Congress passes every day.
Well, I've heard you say that about the courts and now Congress, which is encouraging, but I am inclined to judge your deeds more than your words. And, I'll pick up where one of my colleagues, Mr. Huizinga, left off with the Supreme Court decision in West Virginia versus the EPA. Are you familiar with that case?
Yes, sir, I'm familiar. It's an important case.
Glad to hear you say that. And it would be binding, correct?
It's the law of the land, sir.
That's right. And it introduces a major questions doctrine. And you told Mr. Barr that you received tons of feedback on your proposed ESG disclosure rules, feedback that should make clear that the proposal for ESG disclosure is a major question. And it should make clear that you don't have the legal authority to do that. So I'd ask you to knock it off. Cease and desist and work with this body to pass a law if you want to regulate something. Frankly, your time as chairman has highlighted two problems, a Gary Gensler problem and a structural flaw in the SEC. And as I told you in April, I proposed a solution called the SEC Stabilization Act. You're making the case for this bill easier every day you are acting as the chairman by doing rulemaking after rulemaking without any regard to the impact of these rules, or maybe that's the feature for you, I don't know. But it's having a massive impact on our markets. I mean, we have markets that truly are the envy of the world, and why would you disrupt them with processes that are driving capital out of our markets? Not because to avoid our laws, but to find some place where they can get clarity, where they can work with a regulator and get a decision and a path forward. So instead of selectively applied, you're not providing clarity with a rule that's evenly applied. You're intentionally shortening comment periods to limit feedback. And the courts have even called this arbitrary and capricious. You're pushing a woke political and social agenda, and I think abusing your role and the authority of the SEC as cover. So, I think fundamentally the SEC Stabilization Act would remove the role of chairman. It would preserve the current commissioners, but it would add a sixth commissioner. So there would be no more than 3 from any one political party. And so that would provide a path that would make the SEC do what you're avoiding. Frankly, you're front-running Congress, you're front-running the courts, you're front-running even the own administration, and no one has held you to account for that. I mean, I wish the Biden administration would say you're fired, but the list of folks they need to do that for is long. Congress hopefully will with the SEC Stabilization Act. I yield.
Gentleman's time's expired. We'll now recognize the gentleman from Nevada, Mr. Horsford, for 5 minutes.
Thank you, Chairman, and to the ranking member for the hearing, to Chair Gensler for being here. While investor protection remains paramount for my colleagues and myself, it should not be lost on anyone here that the largest risk our investing public is exposed to at this moment is the risk of a government shutdown. We hear time and again in this committee that our capital markets are the deepest and most efficient in the world, and yet a large part of why they were able to reach their presently enjoyed eminent status is because investors around the globe have confidence that the SEC has the power necessary to maintain fair and orderly markets. Without proper funding in place, the SEC cannot carry out that critical investor protection mandate, and I fear that as funding disruptions become increasingly more common, we risk losing the world's confidence. And so I'll continue working earnestly with my colleagues to avoid a counterproductive MAGA Republican inflicted government shutdown, but I ask all of my colleagues to consider the far-reaching consequences of this short-sighted path. Mr. Chairman Gensler, when we last spoke, I raised concerns regarding the open-end fund liquidity rule, and I appreciated your willingness to consider that the vast majority of my constituents do the bulk of their investing through their retirement plans. These hardworking Nevadans should not be at risk of losing out on today's price simply because they live on the West Coast. Chairman Gensler, as the SEC continues to evaluate its economic analysis for the open-end fund liquidity proposal, what have you been able to ascertain about the disparate impact for investors based on geographic location?
It's been raised by yourself, but it's been raised by members of the public.
Have you resolved it in the rule? And I only have 3 minutes.
No, I appreciate it. I'm not trying to prejudge where we will end up. The overall rule had 3 key parts. You're focused on one, which is what was called the close or hard close. But there are 2 other really important parts. Liquidity. Just what is the liquidity behind?
So will the geographic location be factored in your final rule, yes or no?
It's an aspect of it, but it's still all funds today close at 4 p.m. Eastern Standard Time,
which
so
disproportionately impacts Nevadans and people on the West Coast. So I'm going to keep pressing the issue until you understand that it's a disparate impact on those of us who live on the West Coast. And Nevadans should not be treated unfairly because of where they live. That needs to be factored in the final rule.
I agree,
Chairman Gensler, as Mr. Meeks pointed out earlier, minority and women-owned firms still tend to be smaller as they work to overcome their traditional underinvestment and lack of working capital. As you heard previously, these smaller, more diverse firms will have more difficulty complying with the new disclosures required and will have less ability to absorb the cost associated with doing so. Earlier, you had begun discussing the expanded analysis the SEC made for the disproportionate impact on diverse and women-owned funds when the Commission considered the private fund advisor rule. Would you be able to expand upon your earlier answer that these funds were included in the analysis of small business and give us any specifics that your team found on the potential impacts on these funds?
I'd be happy to have staff follow up with the actual pages and the parts of the economic analysis, but it was considered as part of the effects on small investment advisors, including women and firms of minority-held firms.
Well, it is a waning diversity. The issue of waning diversity in our equity markets is of great concern, and we must be careful about adding any additional burdens on these small firms. And I look forward to working with the SEC specifically on this issue. As I said, it's a wider issue, Mr. Chairman, and I worry that at a time when attacks on diversity, equity, and inclusion initiatives, not woke, like my colleague just referred to, when the next time someone uses that word, will you define what you mean by it? Because to me, it means anti-diversity. It means anti-inclusion. And if that's what you stand for, then you don't represent me or my constituents. We are working hard to hold the line. There is nothing in any court decision by the Supreme Court or anywhere else that should squelch private sector's commitment to diversity, equity, and inclusion. We must use every tool available to us to not only bring new entrants into the financial system, but to also promote their success within our financial institutions as well. I will yield back at this time.
Gentleman yields. The gentleman from Tennessee, Mr. Rose, is now recognized for 5 minutes.
Thank you, and thank you, Chair Gensler, for taking time to leave your virtual office in Maryland to attend today's meeting. And I was also glad to see that you held an in-person open meeting last week for, I think, the first time during your chairmanship. I say that because, Chair Gensler, you are rarely in the office and conduct most of your meetings from the comfort of your home. And what I wonder is, how can we be sure of who you are meeting with on a daily basis? If perhaps someone from Better Markets comes over for dinner to discuss Europeanizing our U.S. capital markets, would that be logged and made publicly available on your calendar?
I haven't had any of those dinners, but hypothetically, if I had that dinner, it would be logged.
I hope so, and I'm glad to hear that. Chair Gensler, in your written testimony, you state that, quote, we also have finalized 24 rulemakings, nearly all of which have changed based on public feedback, close quote. Approximately how many hours per week do you personally spend reading public comments submitted to the unprecedented number of proposed rulemakings issued by the SEC?
I work a lot of hours during the week. My kids are grown and out of the house. My girlfriend lives in a different city. So I don't know how it breaks out. I usually get summaries of the comments, but then staff gives me individual. If it's a member of Congress, I read all of the members of Congress comments personally. But then I get examples in each of the rulemakings, a handful on each of the issues.
Well, I'm glad to hear that as well. Chair Gensler, in May, I co-led a bipartisan letter to you along with my colleague Jennifer Wexton and 22 of our colleagues regarding troubling accusations that the China-backed fast fashion retailer Shein allegedly engages in human rights violations, including utilizing materials that may have been made using Uyghur forced labor. Do you believe that Shein should be required to certify via independent verification that the company does not use Uyghur forced labor as a condition of being registered to issue securities in the United States?
If I might step away from one registrant and go a little broader, Congress passed a law, the Uyghur Forced Labor Act, I think was the name, and that's the law of the land. And so if you're a registrant and you're getting supplies from that region of China, whether you're a U.S. company or a China-based company, we put out guidance, the staff put out guidance earlier this year to all public registrants that they have to speak to if they're in compliance with that act of Congress. Again, materiality matters, and we've been very clear with that with individual registrants in their filings, and our Division of Corporation Finance makes that abundantly clear in each of those registrants' discussions.
Thank you, Mr. Chairman. I ask unanimous consent to have the text of that letter entered into the record.
Without objection.
Chair Gensler, regarding cryptocurrencies and shifting gears, I'm interested in why you have pursued a litigation-heavy strategy, despite the fact that neither you nor any of your senior staff are litigators, neither your chief of staff nor your policy director or even your general counsel. Why have you settled on such a litigation-heavy strategy to address the cryptocurrency market?
Frankly, it's because the field is so rife with hucksters and fraudsters and non-compliant parties, but we've also done rulemaking, one related to broker-dealers that was completed a number of years ago, and then others related to the definition of exchange and the custody rule that's been discussed a bit here, and even something called best execution. But this is a field where the American public's at risk and being harmed every day on these platforms that are commingling and trading, often trading against their customers.
Well, in my view, it seems that these cases are brought with an explicit political agenda, not a substantive legal one.
Nothing could be furthest from the truth. There's nothing, the only thing political is protecting the American public, which I think members on both sides of the aisle probably agree. They don't want to see constituents hurt in a place where a lot of crypto projects are not properly disclosing. There's been all too many bankruptcies, and in the bankruptcies, investors are just lining up at the bankruptcy court.
Well, thank you. In my opinion, I would like to see you do more from the regulatory and guidance side because this industry is so important and we need to foster it, in my view. Thank you, and I yield back.
Chairman yields back. The gentlewoman from Michigan, Ms. Tlaib, is now recognized for 5 minutes.
Thank you. Thank you, Chair Gensler, for being here. I know that you've been pretty public about the fact that, or maybe you made an argument or took a position that it's too costly for firms if the SEC establish a robust climate disclosure rule. Is that correct?
There are many comments in our comment file that have raised that, and that's what I'm talking about, because we, under the Administrative Procedure Act, have to take all those comments and do an economic analysis that takes into consideration the cost.
So in those comments, I mean, one of the things is suggested, I mean, this is despite, I think, about 1,000 companies have already voluntarily reported emissions from their customers and suppliers. We call it Scope 3 emissions, as you know, where most of the firm's greenhouse emissions can originate. So on top of that, we also are now seeing thousands of additional U.S. companies will soon be required to report Scope 3 emissions to comply with the EU standards. And then California, I think, just passed a bill that would require roughly 5,000 public and private companies to report Scope 3 emissions, correct?
Yes, I believe both Europe, and if the governor signs the law in California, that will be the case. And it will change the economics because it, in essence, changes the baseline.
So do you think you're going to look at that? And because those three, you know, just looking at those moves by California, of course, and the EU, Scope 3 emissions disclosures, would it undermine, I think, the argument that such reporting would be overly burdensome to be required by SEC?
While it may change the economics over the course of the years, California's rule wouldn't be in place till 2027, I believe. It's still, we, the SEC, have to stay within our remit and the laws as Congress has passed, and it's about investor decisions and what they're being disclosed.
Sure. So if I may, Chair, I would like to submit for the record a letter signed by 25 of my colleagues, House and Senate, urging you, Chair Gensler, to finalize a robust climate disclosure rule that includes Scope 3 emissions.
Without objection.
You know, it's pretty simple why we need a robust disclosure rule, Chair. I mean, it's simple maybe for me. I know this is what you do every day, but I think the impact on the ground for my families is pretty clear. I mean, currently U.S. companies can and do obscure their exposure to climate risks, as you probably already know, and threaten the investments that retirees and workers depend on. So, for example, like you look at Brookfield Renewable, an affiliate of a giant asset manager, and Brookfield describes itself as, this is quote, one of the world's largest publicly traded pure play renewable power platforms. Sounds like a choice that would avoid climate-related financial risks, right? Wrong. A recent report found that Brookfield Renewable is invested in a fund that holds fossil fuel infrastructure assets, including Alberta oil sands pipelines, which the firm does not disclose in its SEC filings. This is just one example among many, Chair, of financial greenwashing, which regularly involves omission of Scope 3 emissions. So, again, I really think such practices jeopardize the hard-earned life savings of many of my residents and workers across our country, retirees that invested paycheck after paycheck, year after year, to secure their financial future. So just please know, and I want to be on record, that I really would urge you to move forward on having a robust disclosure firm. But with that, Mr. Chair, I would like to yield the rest of my time to Member Foster.
Thank you. I just have one quick question. I take it that you're familiar with this graphic from Bloomberg that shows you lagging significantly behind your three predecessors in terms of the number of rules you finalized in the first 2 years of your tenure?
I did read that in Bloomberg Law 2 weeks ago.
Okay. Now, when your Republican predecessor, Harvey Pitt, finalized 34 rules in his first 2 years and 4 months, I guess, was that preceded by the sort of detailed cost-benefit of all the possible interplays between all of these rules that our Republican colleagues are asking for?
It included cost-benefit, but we benefit from...
But the interplay between the 34 rules, which now is apparently the bar.
Thank you. As best I understand, they did it rule by rule individually.
Individually, yeah. And so when Mary Shapiro did 28, or under Trump, Jay Clayton did 25, rules in the first 2 years? Was there any comprehensive analysis of the interplay that's now being demanded?
Again, we're following.
Gentleman's time has expired.
Thank you.
Gentleman yields. Gentleman from South Carolina, Mr. Timmons, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Chair Gensler, thank you for being here today.
It's good to see you again.
Yes, sir. The SEC's onslaught of rulemaking, I think, is severely impeding U.S. markets in the name of protecting investors from themselves. Your regulatory approach is an insult to the intelligent Americans and their ability to make risk-based decisions when investing. Quite frankly, we've never seen market participation at the levels we see today. The current ecosystem represents a thriving financial sector where people, no matter their income levels, have access to investment opportunities previously unseen in human history. And this is why I struggle to rationalize why the SEC continues down this warpath of rushed and quickly written proposed rules. I could go down the list and probably name dozens of proposals that I think are too broad and they lack quantitative analysis or have reduced comment periods, but I'm just going to talk about a couple of them. So on December 14th of 2022, the SEC released 4 proposals that would overhaul the regulations governing equity markets. These proposals make sweeping changes to how national market system stock orders are priced, executed, and reported. This is despite the fact that there is no indication of a market failure that would warrant such a sweeping overhaul of the U.S. equity markets. Traditionally, regulatory agencies introduce new regulations in response to market failures or when directed by Congress. Regulators tailor solutions to address the specific problems identified. However, with these proposals, there's no clear need for change in the market, nor has Congress mandated such sweeping reforms. The SEC cites the October 2021 SEC staff report on meme stocks as a rationale for the proposed rulemaking. However, the report does not recommend any equity market structure reforms. To this point, you have repeated this buzz phrase, the playing field isn't level. But you haven't explained what that means or cited how it harms investors. Investors have the best user experience and the lowest costs in history. The industry says you're just picking favorites between exchanges versus wholesalers and that retail investors may not actually benefit from these proposals. So that was my long intro. How concerned should we be about the potential for increased costs to investors, especially in scenarios where retail brokers may need to reinstate commissions due to changes like the suggested increase in price improvement?
The proposals were put out to address individual problems, but they really are about driving greater competition and efficiency. Right now, our equity markets, on any given day, depends on the stock, between 30 and 50% is not in the lit markets. It's being traded in what's called the dark markets. And so we're trying to bring more competition in that. One of the rules actually has a tremendous amount of support in the comment file from many market participants is about lowering the minimum increment you can trade at, a penny down to a half a penny, for instance, and things like that. So we're looking at these comments and we're looking through to update our rules.
So currently, tens of thousands of Americans can trade for free and at their fingertips. Do you think that your proposal will result in the reintroduction of commissions?
Zero commission does not mean it's necessarily for free. There's a lot of things that are going on behind. When you send a market order, that's a very sweet order because most investors doing 100 shares are not going to invest another 100 shares or another 10,000 shares behind it.
It's going to result in increased fees for the people that currently have no fees. But
actually, what our economic analysis shows that in each of these roles it would benefit. We believe that the benefits are significant.
Sorry, so you're saying that if this rule goes into effect, that the people that are currently trading for free will not have to pay commissions? Because I think they will have to, because that's how the market's going to inevitably function. You're not going to be able to continue providing free trades if this rule goes into effect.
Actually, again, there's separate rules, but the one I was talking about is in terms of lowering the minimum increment. There's a lot of support for the other rules as well to say that brokers have to give their clients best execution seems pretty straightforward to many of us.
I just think that if we're going to try to provide inclusion and participation in the markets for all Americans, We need to do this with a scalpel and not a sledgehammer, and I think you've been taking a sledgehammer during your time at the SEC. With that, Mr. Chairman, I yield back. Thank you.
Gentleman yields. Gentlewoman from Texas, Ms. Garcia, is now recognized for 5 minutes.
Thank you, Mr. Chair, and thank you, Mr. Gensler, for joining us here today. And I always look forward to your visits, and I'm thankful that you're here, and we're still all here to finish to the end. I want to bring back the poster that was referenced by Mr. Foster. This comes from an article written by Bloomberg Law titled "Gensler Lags Predecessors in SEC Rulemaking as ESG Plans Linger." In fact, they say that you have the slowest pace in decades. We see under Bush it was 34, under Obama 28, under Trump 25, but you've only had 22 rules for the same period of time in the first 2 years. So we've had a lot of talk from the other side of the aisle about all these rules that are too many rules, too quickly, you're not listening, you're not doing enough investigations. But Bloomberg seems to think you're a slacker. Are you a slacker, Mr. Gensler?
I don't know. I leave that to others to comment on, but we do things thoughtfully. We do it by the book. We take the economic advice that we get, and Bloomberg Law has these numbers, so they speak for themselves. I think Chair Clayton, under President Trump, did 64 final rules by the time he finished his 4 years. So our rule agenda is...
So you're not even at half of what the Trump administration did.
Well, the chart says we've done 22. We're now at 24, and he had done 25, I gather. We just do it thoughtfully. We do it under the law, under the economics, and I'll leave it to others to comment. But we're doing it on behalf of the American public and for investors and issuers, and making sure that they don't work for the markets. The market should work for them. And all too often in this country, it seems to get turned around that somehow investors and issuers are there so that some market intermediary makes a profit.
It's all about transparency. Sure. And could you just, in a few words, explain to the average viewer who may be watching today why transparency is so important in this area, particularly in this area?
Transparency helps foster competition in markets. When you have transparent pricing of products, or if you know that a performance of an investment advisor is more transparent, it tends to lower the cost in the middle, and that again helps you, average working or retired American, to invest, but it also helps the people with good ideas. If you lower the cost in the middle, and that tends to come from transparency, just as like when you're buying an automobile, it's good to know the transparency of what a few different auto dealers are charging for that same automobile.
Okay. Well, the other issue that you and I have discussed many times is how important financial literacy and education is in this sector. And the last time you were here, I told you of my concern about financial literacy, not only in my district and in Texas. The Federal Reserve Bank of Dallas reports that 8% of Texans do not have a bank account, and 37% of Texans have not planned for retirement. Financial literacy, of course, is key. Chair Gensler, could you provide an update on the SEC's educational efforts to improve financial literacy, not only in Texas but across the nation, to improve people's understanding of the work that your agency does?
We have an Office of Investor Education. It's a very important office. We also put out investor alerts often on our website, and we try to engage with the public, the broad investing public, to help them understand the markets, but also to protect themselves against wrongdoers in the markets. And if you have something to tell us, to also tell us through the tips, complaints, and referral.
Right. I also have a follow-up question on the financial inclusion regarding not literacy, but language barriers. What are we doing to address any language barriers in behalf of members of our communities and our constituents in terms of investors?
A very important issue. We've certainly done some things recently with regard to shareholder reports, but I think I'd want to come back to you because it's an important issue about language.
Well, thank you. And Mr. Chairman, I also would like to offer for the record the article that I referenced earlier.
That's available to members under general leave and without objection, so ordered. We'll now recognize the gentleman from Pennsylvania, Mr. Muser, for 5 minutes.
Thank you, Mr. Chairman. Chairman Gensler, good to see you.
Good to see you, Mr. Muser.
Thank you. So the SEC's climate rules, Scope 3, provision mandates reporting on emissions from activities not directly controlled by a company up and down its supply chain, as you well know. So supply chains, let's say from China or some other offshore source, for example, which are perhaps less scrutinized and submit data which could be suspect, as opposed to from a U.S. Resource, is an example of how Scope 3 data could be flawed and the system as a whole. So what are your thoughts on that? And is this, is this somewhat of a push towards capital towards certain industries as opposed to something else? I mean, what's the intent? And the other thing I'd like to ask you is, are you fully aware of how it's rattling many companies, right? I mean, this rule won't go into effect perhaps until next year, but companies are preparing for it, and as are private companies. Private companies are preparing for it, and so there's a lot of additional compliance that goes along with it. So maybe you could comment on that?
Two very good questions. First, on many investors are looking at what is the risk of companies with potential climate change. And one of the measures of that risk is the greenhouse gas emissions of the company and possibly their supply chain or so-called value chain. Though many companies know their own greenhouse gas emissions, they don't necessarily know, as you rightly pointed out, their entire supply chain. And fewer public companies are currently publishing that. We put out a proposal to bring consistency to the disclosure, but we heard a lot of comments coming in to say Scope 3 disclosure is not as well developed, it's not as many companies putting out, it's frankly not yet as reliable. And so we're taking that into consideration. And I'd say another thing is, some people have raised from the Farm Belt, for instance, agricultural interest, we don't want to have to do this. We're small family farmers. We don't need to do this. And we, the SEC, don't regulate those private companies, those non-public companies. Mm-hmm. And so staff is looking very closely to ensure that we stay within our authorities, and it's about the public companies. On your second question about cost, we take that very thoughtfully into consideration, and we got a lot of comments. I know I was chatting with the member across the aisle about this, and
Can you give us the
need to
analysis
take
on
that
some
into
of those costs?
consideration.
That was a follow-up question. Can you give us the analysis on the cost that you're taking into consideration? Have you run the numbers and
We're in essence adjusting our economic analysis because we got so much feedback from the public on that. Particularly important point.
On the safeguarding rule as well, are you mentioned you were on and off. Director Berthsel mentioned that he talks extensively with banking regulators. There are many regulators, however, that feel, and this is regarding the safeguarding rule, that if you talked more often with them, this rule would be written differently. What's your reaction to that?
Well, we have good ongoing discussions with our colleagues at the bank regulators. We continue to engage on this role and on other roles, and of course on market oversight. The safeguarding role is one where we've heard a lot from not only the investment advisors that it applies to, but from the banks that act as qualified custodians.
Okay, thanks. I'm changing gears a little bit here. There was a recent shareholder vote to extend the deadline for the DWAC-TMTG merger. Demonstrated that nearly 400,000 investors want this merger to happen. Can you give me your assurance or feedback that a revised S4 handled in regular order will be expedited, whether for this merger or any?
Again, as you're aware, that's a company that recently settled an enforcement action because it had initially had a material misrepresentation of when it went public in its S1. I don't think they've filed an S4 with us yet, but when they would, that our Division of Corporation Finance would handle it in regular order.
I appreciate that very much. I yield back, Mr. Chairman.
Gentleman from North Carolina, Mr. Nickel is recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Gensler, thanks for being here. I want to start by applauding the important work of the SEC and the public servants who work under you. I think there's a lot to be proud of, but a lot of the decisions you've made, I frankly have been scratching my head to try to understand your thought process and what goes into the decisions that you make. And so I tried to figure out, how can I understand Chairman Gensler a little bit more? And I read and saw that you are a marathoner and an ultra-marathoner. Is that right?
Well, in my day, yes, I did do the John F. Kennedy 50-miler.
I looked and found that less than 1/4% of the world's population has done a marathon. I did the New York Marathon, so have at least accomplished one. My first question just is, after being here now for over 3 hours, being on, testifying before Congress in a hearing like this probably isn't one of the things on your schedule that you're super excited about. But how would you rate testifying in Congress and a marathon? Which is easier?
I love being in front of this committee. I've been here probably 20 times in my life. This is a great room and a great committee. Marathons are a little harder.
Well, thanks. All right, so I want to get into securitization.
If the gentleman was suspended, we asked the witness to answer the question. We asked the witness to answer the question.
Oh, wait, I think that this is easier than running the New York City Marathon.
Okay. Thank you. So, all right, securitization. It's a cornerstone of affordable access to credit for families and businesses in my district, represent North Carolina's 13th district. For example, securitization fund around 70% of residential mortgage loans every year and provide funding for auto loans and credit cards. I'm concerned that your rule proposal on conflicts of interest will impair the ability of securitization markets to function by outlawing activities that have no connection with securitization transaction and reducing participation in those markets. This would increase the cost and reduce the availability of consumer, mortgage, and business credit for my constituents, which is a real problem. I mean, frankly, we have an economy that doesn't work for everyone, and it is so hard for so many of the constituents I represent to get credit and to get a loan and to do those things. The SEC said it was, quote, unable to reliably quantify many of the economic effects, end quote, of the proposed rule. Given these uncertainties, and to avoid compounding the credit crunch that's already, again, hitting my constituents incredibly hard, will you commit to reproposing a rule that is more tailored to the feedback the SEC has received from the public?
So, one, the capital markets are really important for credit cards, auto loans, mortgages, and through this securitization market. Two, Congress mandated that we actually do a rule to address potential conflicts that sponsors of those asset securitizations might have if they're on the other side taking positions in conflict with the investors. That's what we're doing. We got a robust, good comment file on that. We're looking at that closely. I can't prejudge it, but I think that the comments that we received, we can hopefully sort through.
Thanks. And I'd certainly urge you to repropose the rule as it threatens to disrupt the housing market in North Carolina and across the country. I want to move on to our grayscale letter. I sent a letter to you yesterday along with my colleagues, Congressman Flood, Torres, and Emmer, urging you to approve the listing of spot Bitcoin ETPs after your recent loss in court to grayscale. Now that the SEC has the court's decision in hand, Rejecting your rationale for denial, does the SEC plan to approve the current pending spot Bitcoin ETF applications?
Thank you for your letter. I did read it last night. Again, we're still taking this under advisement. It's a recent court action, and staff and commissioners will take it up as appropriate.
The court concluded that the SEC's denial of grayscale lacked, quote, a coherent explanation and then, quote unquote, falls short of the standard for reasoned decision making, and then was, quote unquote, arbitrary and capricious. How do you explain the SEC's actions there?
We do that which we do under the law as best we can. Sometimes things go into court. We're still considering that court decision. I think it was a district court. I'm sorry, it was appellate court. It was appellate court, but we're still considering that appellate court decision. And I don't want to get ahead of the staff or my fellow commissioners.
Thanks so much. And I will note that at 3 hours, this is far below my marathon time. Not even close, but I yield back.
Gentleman yields back. We'll now recognize the gentleman from Wisconsin, Mr. Fitzgerald.
Chairman Gensler, thanks for being here. Congressman Lucas and Posey talked about this earlier. I'm just going to bring it up again. It deals with the proposals regarding predictive data analytics. Just could you distill down again? How do you think the proposal is? Is there a lack of economic analysis, and is that consistent kind of with SEC's mission to protect investors? How do you see those two kind of meshing?
So good questions. One, there's a robust economic analysis, but we're going to benefit from public feedback on it. But two, the rationale. On the rationale, it comes to a really key thing. An investment advisor, whether it's through a robo-advisor or a broker-dealer, that they continue to put our interest, the investing public's interest, first, when they're engaging with us, what's called investor interaction, they're not putting their interest in front of ours. So they can use data analytics and use math to put their interest ahead of ours, and that's not good for the investing public.
Are you afraid it'll be applied too directly on just about everything out there? From it could go down to the level of Excel spreadsheets. I mean, somehow it has to be applied. Right?
Here's the sort of balancing act. We're technology neutral. So whether you use, as you say, an Excel spreadsheet or you use machine learning, the core question is, are you engaging with the investors and pushing them for your profits, not your personal profits, but the investment advisors' profits, right, or the investors? But we've got a lot of comments. The comment file is open until, I think, October 10th, so we're still hearing from the public, and this hearing today is a very important part of that.
A couple times you've said the SEC's rulemaking, you're just kind of simply doing what Congress has asked for. Do you think that's consistent? I mean, there's 40-some rule proposals, and I don't know that Congress had asked for all of those. So how are you measuring that right now?
No, you raise a good point. It's not that you asked for it last week or last month, but our laws embodied by Congress are on the books, and we need, I think, really to stay competitive in the world, to update our rule books to make sure that the markets, the Wall Street broker-dealers, the exchanges, the investment advisors, that they're working on behalf of your constituents, the investors, and the people with good ideas who want to raise money. And it's trying to drive greater efficiency in the middle of that market. And sometimes the middle of the market doesn't love that, because greater efficiency might mean a little less economic rents, a little less profits in the middle.
Let me switch gears again. I think we're concerned about FSOC's recent proposal regarding the designation of the non-bank financial institutions as systematically important, particularly the elimination of a cost-benefit analysis requirement. Given your kind of the position as FSOC member, why would the FSOC eliminate the requirement to do a cost-benefit analysis when determining whether or not a non-bank financial institution should be designated as systematically important?
I thank you. I am a member of the Financial Stability Oversight Council, And what we put out to public comment, so I'm only one voting member, but
Right.
what we put out to public comment was really just to ensure that we get back to the guidance that was out there in 2012. I was a proud member back then of that committee too, that council then. And so we've really gotten public feedback on whether to, in essence, could there be financial institutions that were so important to the system, systemically relevant, that they be designated so and then come under the Federal Reserve for oversight?
Very good. I'm going to squeeze in one more here. I'd like to reiterate, Congressman Lukenmeyer talked about it earlier, about the proposed securitization conflicts rule. When you were here, I think it was in April, you mentioned that the proposed rule was new and you hadn't looked at the comment file. At home, Wisconsinites rely on private mortgage insurance for access to affordability and sustainable homeownership. How can you differentiate between managing risk and betting on both sides of the transaction without capturing necessary business activity like this, I guess? Yeah, how's that going to work?
Congress gave us the challenge to do that, and that's why we put it out to public comment. But you're allowed to hedge, you're allowed to do other transactions, but not bet against the investors. And that's, we're still working through the comments to try to finalize. It's a mandate from Congress.
Gentleman's time has expired.
Yield back.
Now I'll go to the gentlewoman from Colorado, Ms. Pedersen, for 5 minutes.
Thank you, Mr. Chairman, and welcome back, Chairman Gensler. I can't believe it's already been 6 months. Time flies when you're having fun. Doesn't feel very fun this week, though. I just want to thank you for your time today and expertise. I know you've discussed this at length today, and it's been a big focus in all of the areas of the key functions that our agencies play in helping support and advocate for our constituents. And, Ranking Member Waters touched on the real harm that a government shutdown would do specifically to your agency. And should there be a government shutdown, only around 400 employees will be retained to maintain minimal functions, with nearly 4,200 employees being furloughed. The bare-bones staff that will remain working during a shutdown cannot perform all the responsibilities adequately. And you've spent time discussing a number of the functions that the SEC will not be able to manage, like protecting Americans from fraud, allowing investors to access our capital markets, and conducting investor outreach and education, among other important roles of your agency. And it is deeply concerning for me with the long-term implications of the chaos and dysfunction here in Washington and the perception globally around what role the United States is going to play in, and if we are a market that people should continue to invest in, and the real concerns out there. And so, in your opinion, how do you think that the government shutdown will impact America's capital markets and the global standard that the global gold standard that we have always had?
In the short term, there's a risk that we, the government's important market regulator, don't have the resources to oversee the markets, whether it's a day, whether it's a month, whatever it is. In the longer term, it's just the confidence in our capital markets and our confidence in our system of fiscal, deciding the fiscal choices that Congress and the administration does. And we see that those challenges in terms of investors around the globe. We're 40% of the world's capital markets. We're only 23% of the world's economy. So and that's a good thing. We're punching above our weight class, so to speak. That's a good thing. But the confidence in our system can be shaken as well.
And we saw that with the recent, not actually coming to an agreement and potentially going off a fiscal cliff. Even though that didn't happen, we know that we were downgraded with one bureau. There's going to be long-term economic consequences. But we know that there's billions of dollars of damage because for the first time, people are questioning whether or not the United States will pay their bills. And so these things, these political games have long-term risks. So I want to spend the rest of my time, this is an area that I know you have a background in, And it's going to be absolutely essential that we're working in partnership to address the opportunities and challenges that AI poses for this country, and specifically for our financial system. And in the morning of May 22nd this year, an AI-generated image of an explosion near the Pentagon spread widely throughout social media. Immediately, the stock market dipped, and we saw a significant decline. We were able to recover when we were able to confirm that was in fact fake. But we know that these are challenges that we're going to have to address together. And Mr. Chair, I'd like to enter the Bloomberg News article, How Fake AI Photo of a Pentagon Blast Went Viral and Briefly Spooked Stocks, into the record.
Without objection.
And so AI has the potential to significantly impact our financial system and our capital markets and our banking system. And this needs to be addressed at every level on how we can mitigate against some of the negative consequences. I'm proud to be joining my colleague and friend in introducing a bill to examine how artificial intelligence will impact the financial sector and how we need to regulate this. So I want to hear from you, though, on what we can be doing, what you recommend that we do to address the challenges that AI poses in the future.
One is, I think it's great opportunities. It's probably going to drive productivity and so forth. But in the financial sector, I do think that there's risk of deep fakes. Look, fraud is fraud. Even if you're using artificial intelligence, there's usually some human behind it. But that's a real challenge to focus on.
All right, I yield back. Thank you.
Gentlelady yields back. The gentlewoman from California, Mrs. Kim, is now recognized for 5 minutes.
Thank you, Chairman. And Chairman Gensler, thanks for being with us today. I am concerned that the SEC, under your leadership, has not carefully considered the aggregate costs of and overlapping nature of your proposed rules and regulations. And as you heard, there is an erratic pace of your proposals. And I want to paraphrase your own words. These erratic pace of your proposals undermines the finest capital markets in the world. And each proposed rulemaking, now over 50 since the spring of 2021, will make it more costly for small businesses to raise capital in the markets and difficult for hardworking investors in my district to benefit from gains in the markets and save for retirement. And I remember when you came before our committee early this year, you said that the SEC's hardcore proposal would level the playing field for my constituents. But I completely disagree with that notion, and I urge you to please revisit the swing pricing and hardcore proposal. I know some of my colleagues across the aisle also raised this issue. So please tell me, how would the hard close proposal level the playing field for my constituents in Southern California when you're proposing a hard close at 4 p.m. in Eastern Time? It is 1 p.m. Pacific Time. So could you answer that?
So again, what we're trying to address is to ensure that when somebody redeems from a mutual fund, they don't leave everybody else in that mutual fund with losses or what's called dilution. I would say, given the clock, right now, anybody in your district already has to put the redemption order in it at 1 o'clock.
Right.
We're not changing that.
Let me reclaim, and I want to tell you that I'm specifically talking about my constituents being put at a competitive disadvantage compared to someone operating Eastern time. So you don't believe that a fund or an investor in California would be put at a disadvantage when they have to stop trading at 1 p.m. Pacific time, whether it's mutual funds or whatever that you're talking about?
I'm just observing currently, because the New York Stock Exchange and the stock exchange is closed by 4 East Coast time, and mutual funds redemptions are by 4 o'clock. That's currently, we're not changing that. That's already existing.
Again, 4 o'clock Eastern time is 1 p.m. Pacific time. So in my home state of California, obviously, we are very concerned about this, okay, because we have to stop trading at 1 p.m. But let me move on. I know in my home state of California, Silicon Valley Bank failed largely because it wasn't hedging it's interest rate risk. And you have proposed a rule on conflicts of interest for securitization that would make hedging this exact type of risk much more difficult. Surely this is not the intent of the statute or your proposal, but it is what the rule as written would do. And I heard your response, your engagement with Congressman Fitzgerald, that hedging is mandated, but that is not what I'm hearing. So I would like to ask you if you can commit to working with me to ensure that the final rule clarifies that risk mitigating hedging is allowed, because the current rule is unclear on that point.
Again, I think it was Congress that has the risk mitigation hedging, but not trading against the investors. And so that's really the job of we put it out to public comment. But you've raised an issue of just broad, general interest rate hedging.
Well, I'm talking about that hedging issue, which is very important. And with all due respect, I believe the lawyers outside of your office disagree. And I think the last thing we want is a chilling effect on hedging. And let me remind you, SVB is a glaring example of how to get things wrong. And I hope we can work together to ensure that the final rule leaves the important risk mitigation tools intact. I just want to talk about some the 34 items on your proposed rules list for 2022. This is triple of that previous year. And in fact, over the past 2 decades, 2021 was the only time the Commission proposed on more rules, so which obviously was mandated by Dodd-Frank Act. The October Inspector General report said that the staff believed that your more aggressive agenda potentially limits the time available for staff resources and analysis and increases the litigation risk. So can I just throw in the question, what sort of things increase litigation risk? Would you be able to respond to that?
Gentleman can answer for the record. Gentleman can answer in written form for the record.
Okay, thank you.
Ms. Presley of Massachusetts is recognized for 5 minutes.
Thank you, Chair Gensler, for joining us today. There are unrelenting people, institutions, forces at work that seek to dismantle gains that have been made in diversity and equity and inclusion, from corner offices, state legislatures, the Supreme Court, and my colleagues across the aisle. In fact, when they got the gavel, the very first thing that they did, one of their very first actions, was to dissolve the DEI committee under FSC that was stood up by Ranking Member Waters, chair at the time, and that committee was headed by Joyce Beatty. So the other side isn't taking any days off, so I'm not taking any days off either. And that's why I want to talk to you about diversity on corporate boards and understanding the importance of disclosure and transparency when it comes to gender, racial diversity, and other data, along with the ways in which that can impact financial performance. We all know that corporate boards are powerful. They play a critical role in determining the mission of a company, its values, its vision, its strategy, everything from who the company will hire to which stakeholders it listens to. Now, for decades, white men have made up the majority of corporate board members, and they still do. Across S&P 500 companies, nearly a third of board directors are women, despite women making up 50% of the country. Only 22% are people of color, despite people of color making up 41% of the country. These gender and racial disparities should not be ignored. The Securities and Exchange Commission plays a critical role in overseeing corporate governance, and that includes work related to diversity and transparency. Chair Gensler, research shows that diverse boards better reflect our country, and I want to underscore this, lead to improved financial results for companies. I could sit here and debate fairness and morality and right side of history all day. But as my good friends at Black Women on Boards so often say, this is not a matter of black or white. It is a matter of green. So this is about improved outcomes. So what is the SEC doing to increase disclosures on corporate board diversity and inclusion?
early in my time at the SEC, we had in front of us a filing from the stock exchange called NASDAQ. It's a self-regulatory organization that actually has a listing requirement of NASDAQ address these issues. Under the Exchange Act, under the laws, we approved that. That's still a matter of court challenge in the Fifth Circuit, if I recall. And I know that that's out there, but I think that...
Let me reclaim my time because I'm running out of it here. That's right. The NASDAQ proposal was approved by SEIC, calls for 2 diverse board members based on gender, race, and LGBTQ status. So this information is important. You agree, yes or no?
Well, we approved it under the Exchange Act, under the guidance there. I have to be very careful about.
Okay. Well, at the end of the day, the disclosure of this data is necessary because we know that which gets measured gets done. So we need that transparency. And I also think that the SEC needs to go much further and require greater disclosure of diversity, such as disability status, and greater disclosure of the company, including senior management and the workforce. So will the SEC commit to looking into expanding diversity and inclusion disclosures?
Staff has continued to work not only on this, but more broadly also on human capital
Yes or no,
disclosures.
Chairman Gensler, my time is running out. Can you make that commitment? This shouldn't be a hard commitment. Can you make that commitment to looking to expanding diversity and inclusion disclosures beyond just the NASDAQ proposal?
The staff of Corporation Finance continues to review alternatives there.
Okay, all right. Thank you. Just a quick history lesson. The first black woman on a corporate board was Patricia Robert Harris, and she was only appointed in 1971, roughly 50 years ago. The year is 2023, and it's well past time that we have corporate boards that reflect the true diversity of our country, not only from a place of justice and fairness, but for improved outcomes, improved financial outcomes. My colleagues across the aisle have already made it clear they don't care about diversity. Their first action when they took back the gavel of this committee was to scrap the Diversity and Inclusion Subcommittee established by Ranking Members Waters. They are on the wrong side of history when it comes to this issue and so many others. Chairman Gensler, it's important that the SEC be on the right side of history and press forward with corporate board diversity.
Gentleman from Nebraska, Mr. Flood, is recognized for 5 minutes.
Thank you, Mr. Chairman. Chair Gensler, I'd like to continue our discussion about SOB 121, staff bulletin from the SEC that would potentially have significant effects on the ability of banks to custody digital assets. Let's briefly begin by following up on something that was raised the last time you were in front of this committee. You previously said that prior to the issuance of SOB 121, your staff did not confer with any of the prudential regulators. Is that correct?
You'd have the transcript, but I think that our staffs do talk to the prudential
prior to
regulators.
the issuance of SOB 121, did your staff confer with any of the prudential regulators?
With regard to that particular
Correct.
staff bulletin, I don't recall that they did. I know that they have.
So let's let the record reflect that the SEC staff did not think to confer with prudential regulators before issuing the staff accounting bulletin. In response to my question, for the record, from April on this topic, you stated, quote, SOB 121 provides non-binding staff guidance on the application of existing accounting and disclosure requirements under U.S. GAAP. Prior to the issuance of SOB 121, Mr. Chair, did FOSB issue anything related to the custody of digital assets, and if so, what was issued?
I'd have to get back to you, but if you're asking about the Financial Accounting Standards Board, I don't know that they had done something on custody, but we could get back to you.
Since you cited the generally accepted accounting principles in your response, I decided I'd take a look at this myself. Prior to SOB 121's issuance, FOSB had not published anything related to the custody of digital assets. In fact, the board added accounting standards for digital assets to its agenda in May of 2022, 2 months after the issuance of SOB 121. Your response to my question, for the record, from April, also indicated that SOB 121 provides guidance on the application of existing accounting and disclosure requirements under the SEC rules. So here's a question. Prior to the issuance of SOB 121, what rules had the SEC finalized relating to the safeguarding of digital assets?
Well, we have on the books a rule from 2009 that applies to the custody of digital assets by investment advisors because it covers all funds and securities. That rule's on the books. We also had finalized something around special purpose broker-dealers, which relates to crypto broker-dealers.
So I took a look at this topic myself. The answer, quite frankly, is none. There were no SEC rules on the books that directly address the topic of custody of digital assets. As you know well, the SEC issued a proposed rulemaking on custody, including digital asset custody, in February of 2023, and that rule has not been finalized to this day. So to recap, the SEC failed to confer with prudential regulators despite the fact that anything changing rules around the custody of assets for banks, regardless of whether the bank is publicly traded, would be of obvious consequence to them. Then, when justifying the bulletin, the SEC cited the gap in SEC rulings. However, at the time when the bulletin was issued, there was no action by FOSB, no rulemaking from the SEC on this topic. In April, you said you wanted the SEC to, quote, stay in our lane, end quote, with regard to SOB 121's potential effects on a bank's balance sheet. It's fair to say that the fact pattern we have is that the SEC is not just going out of its lane, but it failed to comprehend the existence of any conflict with prudential rules. Additionally, the SEC's justification for issuing the bulletin is based on accounting guidelines that did not exist when the bulletin was issued and rulemaking that was not even started until nearly a year after the bulletin was issued. It's pretty obvious that one of two things happened, and both are bad. On one hand, it's possible that the SEC was well aware that there was no strong justification for issuing the bulletin and chose to do it anyway. That would show a pretty straightforward case of regulating by guidance and unsubstantiated theory. On the other hand, the SEC made some obvious basic mistakes in the issuance of this bulletin. In light of these mistakes, it's worth mentioning the SEC Inspector General's report on management and performance challenges. Among other things, the report indicated that very high attrition has required the SEC to rely on detailees with little or no experience to contribute to the core regulatory tasks such as rulemaking. The case of SOB 121 raises the question of whether the SEC is compromised. Thank you, Mr. Chairman. I yield back.
Gentleman yields back. We'll now recognize the gentleman from Massachusetts, Mr. Lynch, for 5 minutes.
Welcome, Mr. Chairman. I don't know if you need time to respond to that.
I would just say, Mr. Flood, if I can, because the other member allowed me to, the SAB 121 guidance is based on GAAP. GAAP already exists. It doesn't need a new FASB statement. And the custody rule at the SEC from 2009 already covers funds and securities to the extent it might be crypto securities. It was already covered. It wouldn't have covered something like Bitcoin, the chair and I have talked about, that's not a security, but it would have covered crypto securities. Thank you.
Again, welcome, and thank you for your willingness to enforce the law where it applies. Appreciate that, especially in the crypto space. After many decisions in favor of the SEC's position, the SEC saw its first split decision, I would say, in the major crypto case in court with the July 13th ruling involving Ripple's XRP. In a partial victory, I guess, for Ripple, the Southern District of New York held that XRP was not a security when sold on a public exchange, but it is when sold to institutional investors, which I found surprising and counterintuitive given the vulnerability of individual investors versus institutional investors, and also the asymmetry that invites into the legal analysis involving crypto. But the wider picture is that I worry that we're heading towards a pattern of court battles to determine if each individual token is either a security or not. And I just wanted to know what your thoughts were on that decision. I know it's far from over. This case is far from over, but I just wanted to express to the committee what your views are on that issue and on that decision, to the degree you may.
I appreciate the opportunity, Congressman, but as we, as a commission, actually have filings in front of that court on this matter right now, I think those filings speak for themselves, and I just don't want to in any way speak to something and say, even choosing a word differently than the commission voted to make filings in that following.
Okay.
In essence, we filed what's called potentially do an interlocutory appeal.
Okay, fair enough. I suspected as much. One of the major proposals in the recent digital assets market structure legislation involves allowing a crypto firm to provisionally register and to be held harmless for a post-registration period. By now, we're all well aware of the damage caused by FTX when its CEO, Sam Bankman-Fried, defrauded millions of customers. More recently, the SEC took action against Binance for potentially, I think, similar behavior from the looks of things. The Binance complaint contains damaging allegations, including operating an unregistered securities exchange, broker, and clearing agency. Further, Mr. Zhao of Binance's operation, control of customer assets, permitted them to commingle, again, just like FTX, customer assets and divert customer assets as they pleased. There are some concerns about this bill that we did, the digital asset market structure bill, that it opens up a vulnerability for consumers to be harmed. And I was wondering if you had a view on that, and is there any concern that we should have with the way the bill is currently structured?
So if I can speak about the field itself rather than speaking about the bill, but it's a common practice in the crypto field right now to commingle that which we don't allow commingled elsewhere. And commingling what you might think of as an exchange, like the New York Stock Exchange, with brokers, you can think of your own individual brokers, and maybe a hedge fund or even a high-frequency trading shop, and even a clearinghouse, and maybe even some bank-like functions. And it's a recipe that has not led to good results in the crypto field and a lot of investors being harmed. So if Congress did anything, it would be separating out those conflicts.
Thank you.
Time's expired.
My time has expired. I yield back,
From
Mr.
South
Chairman.
Carolina is recognized for Mr. Norman is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Gensler, are you aware of Prometheum?
I'm sorry, I didn't
Are
hear
you
the-
aware of Prometheum company?
a company. I have heard of that company. Yes, sir.
Well, they testified before us back on June 13th. The CEO and founder of Prometheum testified before us and he assured us that only 20% of the company is owned by China. Does that concern you at all? And I assume you know they're a broker-dealer, special purpose broker-dealer for digital asset securities.
Any registrant in our markets has to comply with our laws, and whether they're partially owned or wholly owned by China.
But I'm saying in your position, does that concern you? 20% owned by China, and the information that could be easily transferred to China, which is an enemy of this country?
Oh, sorry. What's really important, regardless of whether it's China or any other country, that our capital markets, it's a privilege to be in our capital markets, and that those companies comply with our laws, whether it's the company you mentioned or any other company controlled or partially owned by Chinese entities.
May comply with the laws, but still the threat is there that information is being shared on investors. We sent a letter to you back September 25th, Senator Tuberville and I, You know how long it took us to get this reply?
I'm sorry, September 25th, yesterday? No, I'm sorry.
Of 23, yes. Yesterday, yes, that's right. We did it, sent it 10 weeks earlier. Took 10 weeks, is my point, to get this back. And what we ask you to do is look into that, into the China connection, which is a serious concern, should be of yours and your role. Basically, and I'm not going to read it, this is just a non-response. I mean, it's just words. And if what's concerning to me is if somebody in your role is just shuffling paper, it's a danger to this country.
There are a number of broker-dealers in our country that have affiliation with China. You named one. It's not the only one. I think your letter and some other letters from the senator named some of the others. And those broker-dealers have to comply with our laws. They actually have to, under our laws, have their books and records here so they can be inspected and looked at by FINRA, which you mentioned.
Does China go by the rules? I mean, does Communist China go by the rules?
They have a different set of laws there. They have a different government. But I'm saying if you're here in the U.S., they have to comply.
Here's
with
what we would
laws.
ask. I mean, 10 weeks to get this, and to get this letter, what is it, 2 paragraphs, is really an insult. Are you familiar with metamaterials?
Yes, I am, sir. I'm not very deeply, but it is a company that I've heard of.
Do you know what the aggregate shares are, audited shares, count of MMTLP is, as of close of market on December 8th, 22?
I don't know. I know that it's a company that then exchanged into something called NextBridge, I believe.
Okay. Does SEC have this information on the audited shares?
It may be a matter of public record. I mean, it was a company that it did an exchange and became another company.
We'll try writing you another letter, and if you would look into it, we would appreciate that.
Thank you.
You know, as has been said earlier, the arbitrary rulemaking that is occurring under your rule on theoretical assumptions is really getting our constituents that are involved in the financial markets very upset. And considering you're going way past the boundaries that need to be going. And I think you've made SEC a crusader of rulemaking by enforcement rather than modernizing the regulatory guidance. This isn't something new that you've heard. My only request is that you can blame it on staff turnover, you can blame it on a lot of things, but that you would prioritize this rulemaking and actually we'd make the case for reductions if you would even consider something. I yield back.
Gentleman's time has expired. Gentleman from Texas, Mr. Green, is now recognized for 5 minutes.
Thank you, Mr. Chairman. I thank the ranking member as well. And of course, I'm grateful to the Secretary for appearing today. Thank you very much. It's been an honor to work with you. Mr. Secretary,
I'm honored to have another title, but it's just Chair or Gary.
Chair, okay. All right. Mr. Chairman, excuse me. The traditional services of an exchange, if you perform those, broker, clearing agency, these are the kinds of things that should be registered. Is that a fair statement?
Yes, if you're a broker in America, if you're a dealer, an exchange, not only registered, but then comply with the laws so that the public is protected.
Mm. And in your capacity as a chairman, if you are of the opinion that these things are not taking place, are you duty bound to do what is within your authority to protect the public?
Yes, and we end up being a cop on the beat, and it takes a 5-member commission, but sometimes we bring enforcement actions if people are not properly complying with the laws and registering.
Public Citizen has indicated that crypto amounts to a giant Ponzi scheme whose victims disproportionately include low and moderate income individuals as well as people of color. I'm concerned about that. I appreciate your being the cop on the beat. I want to protect people from what may be a Ponzi scheme. There are different opinions about this, but what are some of the consequences of having a poorly regulated digital currency?
Well, the crypto token field has, there's been billions of dollars of losses, and in fact, there's some studies that suggest that lower income communities and communities of color have lost more, and that it's not been to their advantage at all to be investing in these assets on average. Really, it's a matter of the American public can decide what investment risks they want to take, but they should have the full and truthful disclosure about those investments if they're under the securities laws, and then the trading platforms themselves should comply with the laws and not be entering into a bunch of conflicted services where they sometimes are trading against their customers on those exchanges.
Mm-hmm. Do you consider the dollar, the American dollar, an effective, efficient digital currency?
Well, the American dollar, which is the leading currency around the globe, most of it is digital. I mean, we buy a cup of coffee at Starbucks, or we get paid, or we pay our rent digitally. Occasionally, we still use paper or cash.
And do you believe that properly regulated, we can have digital currencies that won't amount to a Ponzi scheme?
Well, I think the U.S. dollar is quite strong, and I think the U.S. dollar, because we use it digitally already, is a form of a digital dollar. Crypto tokens are really quite something different, sir. They're not a currency. They don't, I mean, this is going back into economic history, but they don't fulfill the three functions of a currency, of a store of value, a unit of account, a medium of exchange. They might, maybe in another day, but not in 2023, frankly.
And our failure to act, or your failure, because you're really the person who's in the hot seat, as it were, our failure to act can cause a lot of harm to a lot of people, as we have seen with one circumstance. And I thank you for what you're doing to prevent that harm. I really do. Thank you.
Thank you.
Go back.
Gentleman from Wisconsin, Mr. Stiles, recognized for 5 minutes.
Thank you very much, Mr. Chairman. Thank you, Chairman Gensler, for being here with us today. This summer, I asked Director Girding about the SEC staff, about whether or not the SEC staff conducted legal analysis of shareholder proposals. And Director Girding seemed to have a tough time answering the question, and I walked away understanding that the SEC does not conduct much, if any, legal analysis of a shareholder proposal. That's troubling to me, because I think that would be one of the roles of the SEC, in particular, following the SEC's review of the particular Traveler shareholder proposal, the racial equity audit, that I think could have driven that company to be forced to engage in illegal behavior. And so asking you if you could give me a clear answer, does the SEC conduct legal analysis of shareholder proposals?
In preparation for the hearing, I watched your testimony between Director Girding and you. I think it is part, and I don't do this on a day-to-day basis, but I think when staff looks at, sometimes companies come in and ask the staff's opinion on things. Staff does look at, one of the components they look at is the legal.
So not every time. So when you say sometime, I think it's just important for us to understand whether or not we should make that explicit. I think it should be explicit. So sometimes the SEC looks at whether or not a shareholder proposal is legal, and sometimes they do not review whether or not a shareholder proposal is legal.
As I understand it, I believe it's one of the components of the review, but I'd be glad to have staff work with your staff and get you the details of the.
I'd like you to. I mean, the fact that you reviewed it in advance of this committee hearing, which I appreciate the amount of time and effort you put into preparing for a hearing, but you don't have an answer specifically whether or not the SEC conducts a legal review, not even a legal opinion, but just a legal review on each shareholder proposal, to me, would be a baseline review for the SEC.
I'm here saying I believe that it's part of the review, but I don't know if it's on every shareholder proposal because it depends on the nature of the shareholder proposal, of course.
Okay. I'd like you to come back with that information about the process in which you review shareholder proposals in light of probably two key things. One is we brought in the two largest proxy advisors, ISS and Glass Lewis, and they specifically said on the record that they do not conduct a review for legality. They instead rely upon the SEC's analysis for legality. On the record in this committee room, your director and now you kind of go back and forth as to how you conduct that legal review. I think it's really important for us as policymakers to understand whether or not anyone, the SEC or proxy advisors, which may not be under, we can get to how they're registered with the SEC, but who's conducting the legal review because it has a significant impact on companies. And if we build upon that and we look at the Staff Legal Bulletin 14L, we've seen a dramatic increase in the number of shareholder proposals. We're seeing more focused on social and political concerns. And I go back and look at the underlying language of that legal staff bulletin saying that they would consider whether or not a proposal concerns a matter of widespread public debate. Can you define widespread public debate?
I think, sir, that it's really, and this goes back all the way back to the 1960s, of shareholder proposals, that investors can make shareholder proposals on the term you used, on wide scale.
Widespread public debate is your legal staff bulletin.
And that goes back many decades.
But can you define it? I understand there's a history to it, I understand, but legal staff bulletin came out under your chairmanship. Can you define the term widespread public debate?
And the staff does, when asked, give their informal advice, but ultimately it's between the company and the investors.
Understood, but don't you think that's of concern that you can't define what widespread public debate is when your staff bulletin says that that's a point of review for shareholder proposals? I'll offer you that it concerns me, in particular in light of the dramatic increase in the number of shareholder proposals we've seen that are based on social and political objectives rather than governance of the nation's largest companies. See if I can get this in really briefly. We've discussed your use of email. You've had an aggressive enforcement campaign on off-channel communications for financial firms. Have you used anything other than official SEC resources to conduct your government business?
No, I comply with the laws, but I also, if somebody sends me an email, then I forward it into the SEC.
Thank you very much for your time. I yield back.
Gentleman from New York, Mr. Garbarino, is recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Gensler, thanks for coming today. Financial services sector and the Biden administration have made harmonization of cyber incident reporting a top priority. In fact, the Department of Homeland Security Cyber Incident Reporting Councils recently recommended the federal government coordinate among themselves to reduce the burden on the reporting entity. But instead of reducing the burden, the SEC has finalized rules that CERC has called duplicative cross-sector reporting requirements and that overlap with congressionally mandated Cyber Incident Reporting for Critical Infrastructure Act, the CIRCIA. Given the Council's designation, why didn't the SEC harmonize its cybersecurity disclosure requirements with existing regulations, and more importantly, wait until the Department of Homeland Security and CISAs developed the rulemaking under the recent signed into law CIRCIA?
One, we've had good discussions with the Department of Homeland Security, but we finalized the corporate disclosure piece because it was important for the public investors to know if there had been a material cyber breach.
Is it more important? Is investor information more important than Homeland Security? Well, and I asked that question because the reason we want to harmonize, and the reason we as a Congress have said harmonize, and the reason the Biden administration has said harmonize these incident reporting rules, is because we've heard from the private sector that their cyber employees are spending 40 to 50% of their time, and we've spoken about this before, on complying with cyber regulations, not just yours, but with all sorts of different cyber regulations. So and we talked about this last time we were here, specifically the rule that was just finalized in July, and you said at that time you've been having good discussions with DHS. But again, this rule came out, and and DHS said, I quote, that this current rule is duplicative cross-sector reporting. It's a duplicative cross-sector reporting requirement. So even though you've had good conversations, I guess they didn't lead anywhere because you still came out with the rule. Actually,
they did, because it's only reporting to the public if it's a material cyber event. It's 4 business days, which actually is longer than the CERSHA 72 hours. And thirdly, has important considerations in there that if the Department of Justice thinks for national security or public safety it should be delayed, it will be delayed. It is longer. 4 days is longer, but within a material breach, there's different requirements there. So I have to ask, because there's also a concern that you have companies that are reporting a possible material cybersecurity breach that might not have been able to fix that breach. And if they're publicly reporting it, it could, 1, put that company at further risk, or 2, put other companies who are using the same system, and the same backdoor can be found in their system. We just saw over the summer a company, there was an attack on a company. They announced this attack before the patch was released, and you saw other companies and 3 federal agencies get hacked under the same vulnerability. So I'm concerned that having this public reporting before the breach is fixed, before the patch is fixed, is going to cause more harm than good. And I'm not saying don't regulate cybersecurity. I think it's very important. I just think when our goal is harmonization, when the Biden administration's goal is harmonization, when everybody is saying harmonization, having these rules come out that are just going to be duplicative and cause more harm on the companies that are supposed to be protecting information is not a great idea. I'm running out of time, so I do want to move on to something else. Between 2019 and 2022, the annual cost of operating a consolidated audit trail, or CAT, increased by 900%. In March, CAT unveiled a 2023 budget exceeding $223 million, which is 10% of the SEC's entire budget. The SEC recently approved a funding model that would pass nearly all these costs on to market participants. What is the SEC doing to control the costs of CAT? I understand SROs control and operate them, are owned and operated, but it's under your umbrella. I need to know what you're doing to control those costs, and if you would support moving CAT onto the SEC's budget. I don't know, Mr. Chair, what you're going to tell me.
If the gentleman would respond in written form to the gentleman's question. And I appreciate the gentleman's leadership in cybersecurity issues, the WIGWIM protocols, and the work he's put in over the years on those policies. He's worked in other committees. So,
and WIGWIM is very important.
We'll now recognize the gentleman from New York, Mr. Lawler, for 5 minutes.
Thank you, Mr. Chairman. Chair Gensler, you have embarked on a rapid and extensive campaign to reform every facet of our markets. It is evident that your rules will significantly change our markets. For example, your equity market structure rules will impact all retail investors, encompassing over 228 million retail accounts. The swing pricing rule will have implications for every mutual fund involving over 100 million American investors. The climate rule imposes new costs on every public company. The predictive analytics rule will encompass virtually every type of technology. The private funds rule fundamentally reshapes the regulation of private institutions in a potentially unlawful manner. The pace and scope of your rules is unprecedented. Have you taken the time to do a comprehensive economic analysis examining the cumulative impacts of all of these rulemakings on the markets and broader economy?
Representative Lawler, actually our pace is about the same as prior administrations, and per
That's
Bloomberg
not,
law article.
respectfully, we can disagree with that, and that's not what I asked you. I asked you a very specific question. Have you taken the time to do a comprehensive economic analysis examining the cumulative impact of all of these rulemakings on the markets and the broader economy? Yes or no?
On each of the rules, we do a robust economic analysis, and then if another rule is finalized, we incorporate that, and we take into consideration that interaction in the possible further rulemaking and adjust the economic baselines.
So you are saying, for the record, that you have taken the time to do comprehensive economic analysis, examine the cumulative impact of all of these rulemakings on the market and the broader economy, yes or no?
For the record, what we do is we take into consideration, as and if a rule is finalized, the interaction with other rules.
Right.
Because it changes what's called the economic baseline.
Yes. So have you done the cumulative impact? Have you studied that? Have you done an economic analysis on all of it?
We do them rule by rule individually,
Yep.
and also the interaction as it relates to other rules. If we were to finalize a rule, then we take that in consideration.
So can you explain your engagement with market participants before putting out significant rule proposals? Are you holding public roundtables?
We meet with the public extensively. Before the equity market rules, we had numerous meetings from when I came on in the summer of 2021 all the way through December of 22.
Chair Gensler, California Governor Newsom recently confirmed his intention to sign 2 bills mandating climate disclosure into law. You mentioned to the press last week that the SEC staff is, quote, going to take a look if it were to become law because it may change some of the economic baseline for our rule, end quote. It's evident that the law will indeed alter the economics of your rule. So can you make a commitment to allowing the public an opportunity to provide feedback on the Commission's updated economic analysis before finalizing the rule?
We take in consideration public comment. We've had 16,000 comments, a lot of comments on the economics, and we often will adopt based on those comments.
No. What I'm asking you is, based on the reevaluation, based on the potential change in law, will you commit to allowing the public an opportunity to provide feedback on the Commission's updated economic analysis before finalizing the rule?
I would say this: we're compelled. This is an important thing. California.
It's a pretty straightforward question. Will you allow the public to comment on the updated economic analysis before finalizing the rule? Yes or no?
We would put it. We would if
Sir?
If we finalize a rule, it would be part of that finalized rule.
Okay. I know you like to obfuscate, but I'm honestly asking you
sir,
a very straightforward
sir,
question.
I understand.
Can you commit?
Where you're headed.
Can you commit?
No. The answer
So you
is
won't
no.
commit. Thank you. At least you answered the question. Thank you. I want to touch on another factor here. The SEC recently proposed amendments to expand and update regulation systems compliance and integrity. The proposal would expand the scope of SCI entities to include certain registered broker-dealers for the first time. Feedback from market participants on this proposal suggests that the actual costs for this proposal are in the billions of dollars as a result of the SEC attempting to micromanage the technology setup of individual firms, yet these enormous compliance costs are conveniently absent from the SEC's cost-benefit analysis. Why did the Commission fail to acknowledge these costs in its economic analysis?
Gentleman's time has expired. If the Chair will respond in written form.
Thank you.
We'll now go to the gentleman from Iowa, Mr. Nunn, for 5 minutes.
Thank you, Mr. Chair. Chairman Gensler, thank you and welcome back to this committee. I know each time we get to have a lot of questions on this. Last time we spoke, I addressed swing pricing and hard close proposals with you. I also want to reemphasize here the devastating impact that's had on many of my hardworking constituents, from their retirement plans, their 401ks, my nurses with 457 plans, my teachers with 403B plans. I think you get the gist of where we're going with this. As you are well aware, after this morning's rule, I believe it needs to be withdrawn, and I look forward to your team's response to both Chairwoman Wagner and Ranking Member Sherman on the letter that we signed on to and are still awaiting to hear back on. Look, I want to talk specifically here about the ag and small business communities that I represent. The extra regulations that the SEC is potentially proposing in this regulation under the guise of consumer protection is going to add $6 billion in increased annualized costs to the industry, an additional 6 million compliance hours, many of these being small family farms and medium Main Street businesses. I hope you appreciate this has a tremendous impact on my constituents back home. Along with 4 other members of the Ag Committee on which I serve, we have signed a letter here moving forward a conversation, which brings me to my question on the February 15th proposal rulemaking on safeguarding client assets aimed at reshaping custody assets. As you know, we have worked hard in your former role with CFTC on how this can be successful. But dozens of trade groups have signed up and identified that this rulemaking would represent trillions of dollars of assets that our constituents back home face. Both of these letters, Mr. Chair, highlight significant errors with the proposed rulemaking, and I'm going to begin this conversation by asking you to consider withdrawing it until these things get fixed. Your definitions of custody and asset would expand so greatly they would encompass derivatives and future markets that have been overseen by the CFTC, your former organization, for decades. So with these bipartisan letters specifically, I believe that they would upend our markets overseen by the CFTC, eroding their essential risk management functions and putting our nation's farmers and producers at risk. Now, Chairman Gensler, in your 432-page proposal on economic analysis, do you know how many times agriculture was mentioned as part of this review?
I don't recall, but I suspect you're going to let me know.
Would it surprise you to know not once? In fact, it was only mentioned as a subcategory within a footnote. Clearly, this is concerning, particularly for my farming constituents, but for entire economies built around this, something the CFTC has been doing for decades. So, Chair Gensler, earlier you answered Representative Lucas' question. Has there been any coordination with the SEC and the CFTC on this issue?
Yes, we've been in dialogue both prior to the proposal and subsequent to the proposal, and I think that...
Can I get some specifics on that? When did you send a request over to the CFTC for this coordination? The day of before the proposal? A week before the proposal? After the proposal was already out?
Representative, it usually just is staff-to-staff dialogue. So it's,
Great. I look forward for your staff providing me the date in which you actually asked for this information from the CFTC. Did the CFTC provide you with any recommendations on your rulemaking?
We engage with multiple federal regulators on this role, and we'll continue to do that because we benefit from that feedback.
I'm very happy to hear that, Mr. Chair. I'd like to see that being transparently provided to this committee then. Did you read these comments, and were they incorporated into your final proposal?
Sir, we haven't finalized a proposal yet.
Did you incorporate any of CFTC's
We haven't finalized an
recommendations?
adoption yet.
Mr. Chair, did you incorporate any of the CFTC's proposals into your recommendation?
We have put out to public comment to get feedback, and we get feedback, and it's benefiting this, and I think that we can...
So I haven't heard anything about the CFTC on this. You're putting it out to the public, which brings me to my next question. It's my understanding that you recently reopened the comment period without re-proposing the rule. Specifically, what value does this add to the ag community and my constituents for their grave concerns if you're reopening it, but you're not listening to the CFTC, the ag committees, or even what's happening on a bipartisan level within this committee?
We benefit by reopening. I think we reopened this because we had another rule that may intersect with this, the discussion we've had a lot here today, and so we reopened it formally to get further comment.
It might suggest to some that you didn't get the answers you wanted, and so you reopened it to others. So let me end with this. I urge you to withdraw this rule, as my bipartisan and bicameral elements have argued the same. Thank you, Mr. Chair. I yield the remainder of my time.
Thank you. Good to be with you.
Gentleman from Florida, Mr. Donalds, is now recognized for 5 minutes.
Thank you, Mr. Chair. Chairman Gensler, welcome back. Hey, do you remember where we left off, you and I?
I do. You're a very good questioner, sir.
All right, well, let me refresh. Let's bring some things up. Where we left off was, did you facilitate the payment for the Steele dossier for the Hillary Clinton campaign back in 2016? Because you were the CFO. You acknowledged that. You also said, in response to my question, that this payment was not something that I was aware of, quote unquote. Those are your words. Interesting things have occurred since then. John Podesta actually testified to a committee of Congress, and John Podesta testified to a question about, was Gary, meaning you, was he day-to-day, hands-on, signing every check? And so John Podesta testifies, actually he was under a deposition with a committee here in Congress. He says, yes, I don't know if he signed the checks, but he was there every day, meaning you. So let's circle back. Were you aware of the fact that the Hillary Clinton campaign actually paid for the Steele dossier, which unleashed one of the worst issues of intelligence malfeasance that our nation has ever seen?
No, sir, I answered this 6 months ago, and this is the same answer today. No.
You weren't aware of what was going on? Mr. Gensler, I find that very interesting because, if I listen to some of the people and the staff that have left the SEC, you're very aware of everything that is going on. It's actually your MO. You're very hands-on. So you're going to tell the committee right now you had no idea that the Hillary Clinton campaign, of which you were the CFO on, sent money to Perkins Coie for a dossier that was phony, that led to the spying on of a presidential campaign in 2016. You were not aware of any of this?
Look, sir, as a chief financial officer in a political campaign, I was not aware of what a law firm was doing with some of the money that they got.
Now, I find that interesting because in some of your other rhetoric about CFOs in the public sector, the private sector of our economy, you are very tough on CFOs. You've said on the record on many occasions that CFOs have a fiduciary responsibility to the organizations that they cover, that they should be aware of everything that is going on. So how is that a standard you hold CFOs in the private sector to, but you don't hold yourself to that same standard?
That's not a standard that the SEC holds CFOs to. It's about their financials and that the financials are put together in accordance with GAAP and that the numbers are accurate. And that they're
So did you accurately pay for the Steele dossier out of the Hillary Clinton campaign?
Sir, I learned about that way after President Trump was a president and Hillary Clinton was a private citizen.
All right, well, let's move on. We'll probably circle on that another time. I want to reference a story in Capital Account from June 13. Mr. Chairman, I ask for unanimous consent for the story be entered into the record.
Without objection.
The story notes that you met with Senator Tammy Baldwin in May about the SEC's proposal related to the 13D beneficial ownership disclosure, at which time you allegedly asked Senator Baldwin's staff, allegedly, to contact an organization called We the Investors to submit comment letters in favor of the 13D proposal. Subsequently, the SEC was flooded with 350-plus comment letters from so-called individuals, but mostly form letters stamped with the moniker We the Investors in favor of their proposal. It appears to me that you have engaged in astroturfing to advance your own agenda. Is this true? If this is true, is this a serious breach of impartiality that would violate the spirit, if not the letter of the law of the APA?
Sure, again, I don't know what the press is talking about. I remember a meeting with the senator. It was a good thought.
Did you meet with Senator Baldwin in May with respect to 13D?
I think that it's on my public calendar that I met with Senator Baldwin. I meet with senators and representatives.
Okay, so here's what I need to get from your public calendar if you actually met with Senator Baldwin. I think the committee would like to know that. In this meeting with Senator Baldwin's staff, did you speak to an organization called We the Investors?
I have no memory of that.
Mr. Gensler, the no-memory routine from a lot of appointees is really getting old. You guys are discussing and leading some of the various regulations facing our economy. So to come before a committee of Congress, have no idea what you talked to with a senator's staff about 13D?
The meeting was with the senator, sir.
All right, well then, if you don't recall what you said to a United States senator about key issues facing our economy
no,
from a regulatory basis?
Please, sir.
That's a real problem,
You're
don't you
a good
think?
questioner, but please, sir, that story is not one that I would confirm. It's not a story that I believe is accurate.
Let me ask you a question, broad base. Do you think it's appropriate for the chairman of the SEC, or frankly the head of any agency, to engage with outside groups to accomplish the agenda they want to see through rulemaking?
We are responsible under the Administrative Procedure Act to hear from outside parties, market participants, constituents in your district, members
No,
of
that's not my
Congress.
question. We want to hear from outside groups. Is it
We're
okay to foment outside groups to help you
Gentleman's
accomplish what you want to
expired.
see?
Gentleman's time's expired.
Thank you, Mr. Chair.
Gentlelady from Indiana, Ms. Houchin, is recognized for 5 minutes.
Thank you, Mr. Chairman, Ranking Member Waters, and thank you to Chairman Gensler for speaking with us today. Chair Gensler, under the last Democrat chair of the SEC, Mary Jo White, the Commission adhered closely to the statutory authority of Congress. During her time as chair, 59% of the SEC's proposals were mandated by Congress. By contrast, under your leadership, only 17% of the Commission's proposals are mandated by Congress, according to a report from Professor Hal Scott of Harvard. Why is there such a rush under your chairmanship to promulgate so many rules without specific mandates from Congress?
It's because technology and the markets have changed so much. She was coming in as chair right after a financial crisis, so naturally there was, I think, 120 mandates that Congress placed. But you're accurate. We've picked up about 10 of those from Dodd-Frank, one from the Holding Foreign Companies Accountable Act.
Chair Gensler, there's a perception that the SEC is neglecting public input, and particularly from bipartisan letters that the members of Congress have sent to voice valid concerns regarding individual rules and the rulemaking process. The concerns encompass the bipartisan concerns about insufficient comment periods and a general response to bipartisan concerns regarding proposals on swing pricing, liquidity risk management, and equity market structure. Are you aware of similar bipartisan concerns being raised with previous SEC chairs? If not, could you elaborate on why the opinions of Congress don't factor into your considerations?
Well, the opinions of Congress most definitely factor into my consideration.
It doesn't seem so, Mr. Chairman. It does not seem so when only 17% of the proposals that you have brought forth are the result of mandates from Congress. I find it incredibly frustrating that any time we provide comment or send what we call strongly worded letters about our opinions on how the SEC should behave, it seems like these must be immediately thrown in the trash and disregarded. I want to turn to Reg SCI. The SEC originally adopted Regulation Systems Compliance and Integrity, otherwise known as Reg SCI, in 2014 in response to several market disruptions at national securities exchanges. Earlier this year, the Commission proposed to expand Reg SCI to certain broker-dealers. However, unlike in 2014, the Commission fails to provide a single instance of a broker-dealer systems disruption that had a significant market-wide impact in the securities markets. In fact, the SEC's own proposal acknowledges that broker-dealer systems performed well during the unprecedented trading volumes and volatility at the height of the COVID-19 pandemic. Further, the Commission admits that it, quote, finds it impracticable to quantify the many benefits associated with amended Regulation SCI. Once again, this seems like the Commission is providing a solution in search of a problem. Chairman Gensler, given that the Commission cannot point to a single broker-dealer systems disruption or any tangible benefits to applying Reg SCI to broker-dealers, how can you justify that proposal?
As we outlined in the proposal itself, which is still out for public comment, that some broker-dealers may have the size and scale and standing in the markets that if they were taken down, that could be disruptive to the markets. That's the important thing. And this so-called systems compliant integrity is about those most consequential or central parts of the market.
The SEC's RegFlex agenda for 2023 indicates you intend to finalize proposed rulemaking to expand the definition of an exchange in short order. Although the SEC has reopened this rulemaking, the proposed rule is still fraught with insufficient economic analysis and ill-defining scope, among other things. Given Congress's ongoing and unaddressed concerns with the rulemaking, as well as concerns of hundreds of stakeholders, it seems irresponsible for the SEC to finalize this rulemaking. Could you comment on the expected timeline for finalization of this rule?
You'll be pleased to hear that we don't do it against a clock. It's really when we get the the comments and the economics right and the legal authorities right, and then discuss it with the commissioners.
And finally, I want to raise an alarming issue that I think needs further attention: the timing of various actions by the SEC while Congress is seeking to establish a regulatory framework on digital assets. To name a few, January 12, 2023, this committee announces the formation of the Digital Assets Financial Technology and Inclusion Subcommittee. It was subsequently announced that the SEC pursued enforcement actions against 2 firms. March 9, 2023, the committee hosts its first hearing on the Biden administration's approach to digital assets. An hour before the hearing, you publish an op-ed in The Hill. April 27, 2023, the committee hosts another hearing on digital asset regulation. You tweet and quote office hours video on your view that most digital assets are securities. May 3, 2023, this committee and the House Agriculture Committee, led by my colleague Chairman Thompson, announced our first joint hearing on digital asset legislation, which is unprecedented. You published another office hours. I'm not one to connect dots, but it seems like you're actively trying to undermine the work of Congress. You must not impede our work to do our job, even though you won't do yours. I yield back.
If the gentleman wants to respond.
I very much respect the work of this committee, and particularly the work of this committee around crypto assets. We have a robust time because this is a field that's rife with fraud and abuse, and so our enforcement agenda sometimes does roll out while you're doing your good work here as well.
Mr. Ogles of Tennessee is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Gensler, thank you for being here. I do want to echo the chairman and support the chairman that, I think we've come to this crossroad where subpoenas may be necessary. It seems that compliance and requests for information and documentation has been kind of shortcoming. And so with that, Mr. Chairman, you have my full support when and if you decide to move forward. But Mr. Gensler, I want to kind of, one of the things that concerns me is sometimes the subjective, or what the perception of subjective and arbitrary nature of the rules. In May 25, 2022, the SEC proposed amending the names rule to further regulate the names of investment funds. Well, I think everyone would agree that it's misleading of a fund called the Mexico Growth Fund, made most of its investments in Japanese value stocks. Many names may be subject to differences of opinion. The proposal specifically mentions ESG funds. Mr. Gensler, is the SEC equipped to determine what, broadly speaking, is good for the environment as it pertains to ESG?
No, sir, we're not an environmental regulator.
So again, going back to the subjective nature of some of the rules and the compliance that is forced, I mean, it's kind of like what's better than environment, paper, or plastic bags? And so when we should be focusing more on the fiduciary aspect of a fund versus its environmental compliance, I have concerns. When you look at the social component of ESG, who would you entrust, or how will you determine whether or not a company is compliant with the social portion of ESG?
So in terms of this names rule, it was basically truth in advertising, that if you're going to say you're a social fund, to use that, you have to actually then describe what the marketer of that fund means by social, and then ensure that you invest as you're marketing to the public. This was really a rule in most regards, or the names rule adopted in 2000, 23 years ago, to protect the investing public, that the advisors they pick are doing, that they say what they mean and they mean what they say.
So, but again, to my point, this creates a very subjective nature to the rules process, right? Because you just said that you don't have the capability to judge the environmental component. You don't have the capability to judge the social component. And so now if there's a clear definition and disclosure in the prospectus, who is to determine whether or not they're compliant, right? And so you now have a rule that can be abused, or a rule that's completely useless. And so why even have the rule when at the end of the day it should be about?
Well, it's sort of like, as one of my fellow commissioners said when we voted on this rule, if you say that you're selling pepperoni pizza, that there's actually pepperonis on the pizza.
I like pepperoni pizza, so don't get me wrong, right? But yeah, I just look at, and forgive me, these rules outlive any given administration, but under this current administration, the Biden administration doesn't necessarily have the greatest track record of trust with word definitions. So, and I don't mean to be, contrarian here, but if the administration can't figure out what a woman is, how do I trust them to have any kind of bearing or judgment on?
I totally understand what you're saying, but that's not what we adopted in a names rule, is that if you're marketing to the public that you're, let's say, an environmental or a green fund, you describe what that means and you ensure that at least 80% of the investments in the fund meet your self-described. Sure. You can describe what a pepperoni pizza is, but if you describe it, you better comply with it.
But again, I just, so when you look at like the climate disclosure and the burden that's being put on businesses to track their supply chains, you're now creating an enforcement mechanism that the company has to enforce on its supply chain. So again, these rules that you're pushing down on business, that you're pushing down on these instruments, only does one thing but drive up costs on, at the end of the day, the end use. So the very people that you're trying to protect, you're hurting because of the arbitrary nature of the rules that you've put in place. It's very frustrating. And again, Mr. Chairman, I'm about out of time, but I was just going to say that I would say open up the floodgates, hit them with subpoenas, get the information we need, the obfuscation and not answering questions. I'm sick and tired of it. I've sat back here and I've listened to this entire hearing. I mean, dude, you wear tap dancing shoes better than Fred Astaire, and enough is enough. And I don't mean any disrespect, but it's time that questions are answered, that we have the information we need. Mr. Chairman, I yield back.
Thank you, Mr. Chairman. Thank you, Chairman Gensler. It's 2:29. It's not your longest day in a committee, but thank you for being here. As I stated in the outset, it's my request of you and your agency to comply with our request as a committee. I don't want to use the compulsory process for the first time in our history between this House of Representatives, this committee, and your agency. So I think it's would be a purposeful act on your part if it resulted in us issuing a subpoena. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witness to the chair, which will be forwarded to the witness for his response. I ask you, Chair Gensler, to please respond no later than October 30th to those written questions. This hearing is adjourned.